Has it gone too far? Probably not, because again, it has 40 years of success to build on.
Tony, there's the jump condition indicated by rhetoric from the Federal Reserve. There's also the jump condition from liquidity, especially as the Fed stops soaking up as much of the off-the-run treasuries. Not to get all geeky, but a lot of people have pointed to a lack of liquidity and some of the distortions that we're seeing. How much can we get a clear read on the yield curve, on some of the dynamics in a bond market beset by all of these liquidity issues?
Great question, Lisa, and it's an important question to be thinking about this decade because it's a lot different than other decades. The so-called principal agent model is broken, which is to say that it's difficult in the bond market to find an intermediary to transfer risk, whether that be to gain it or to lose it. Here's one quick example. The primary dealers, those that are the go-betweens, the intermediaries, large investment firms, they held $300 billion of corporate bonds in 2007. Today, they hold less than $10 billion, despite that corporate bond market doubling in size. In other words, intermediaries aren't willing or able to hold inventories like a game of hot potato every day. And during periods of stress, it's even worse. And so this is an issue that the Federal Reserve and others that construct the architecture of the bond market probably should think about, because it makes things difficult, again, especially in times of stress.
Tony, love catching up with you, sir.
Tony,
thanks for being with us this morning. Tony Presenti there of PIMCO. From New York City this morning, here's the shape of things. A big rally yesterday on Wall Street, and we add to the gains. We add some weight to the S&P 500, up another 1.36% on the S&P, advancing 62 points. Tom says, look at the NASDAQ, let's do that. The NASDAQ 100 up 300, advancing 1.9%. 10-year yields at 144, crude reclaiming a 71 handle, WTI up by almost 3% this morning, advancing 2.9%.
I don't have it in front of me, John, but Morgan Stanley with an up on Apple as well. Katie Huberty there really lifted up. I don't know if it's a Dan Ives level, but you know, we got to make note here. We're seeing sell side step in. Betsy Grasick yesterday with what she did with Goldman and Wells Fargo. Katie Huberty today on Apple. John, all these people are resetting for a Q1 that's a boom American economy, even if it is a large inflation component.
I imagine we're going to see a lot more of those calls from the likes of Betsy Grasick and Morgan Stanley, Lisa, upgrading the banks, Goldman to equal weight, Wells Fargo to overweight off the back of their call, at least on the analyst side of things, for 3 additional rate hikes from the Federal Reserve.
Why aren't we seeing it priced in, though? I mean, I really have been taken by the underperformance of the bank stocks in the past couple of months, especially because people are increasingly pricing in a rate hike next year or 2 or 3. And this, to me, is what I really want to hear addressed at the Financial Services Conference today, including how much consumer lending can get back up to speed.
How high can rates go?
Yeah.
65 basis points at the front end, people talking about 3 hikes next year, maybe 4 in 23, et cetera, et cetera. Just on Morgan Stanley, Tom, from Mike Wilson over the weekend into today. Lisa, your response to this, please. A new COVID variant started the ruckus for markets, but we view that as secondary to the real culprit, the Fed's more aggressive response to the on-fire data. Lower valuations, their call for 22. Tapering is tightening.
To me, that rings true. I read that and I thought to myself, this rings more true than the Omicron variant that by all accounts seems to be at least fading from the market sentiment.
We've got the volatility.
John, it's good to have Lisa back.
Just not the index level correction. You're going to have to say way more than that to win Lisa back, Tom.
Early score.
You're going to have to do that every single segment.
Thank you, John. I appreciate it. I'll take it.
That doesn't win Lisa back, Tom. Up 63 on the S&P, advancing 1.3% from New York City. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The US and Europe are considering tough financial sanctions against Russia if Vladimir Putin invades Ukraine. Bloomberg's learned that Russia's largest banks would be targeted, along with the country's ability to convert rubles into dollars and other currencies. President Biden may spell out the sanctions today when he and Putin have a video call. Russia has denied that it plans to attack Ukraine. The outbreak of the Omicron variant has led to restrictions being imposed around the globe. France shut down nightclubs for 4 weeks, and New York City called for a private sector vaccine mandate. Meanwhile, South Africa's rate of positive tests jumped. Still, the surge of cases hasn't overwhelmed hospitals there so far. Some China Evergrande Group bondholders didn't receive overdue payments by the end of the month-long grace period. That signals a possible default by the struggling developer. Evergrande is preparing for one of China's biggest ever debt restructurings. And Republican Congressman Devin Nunes of California is quitting Congress to head up Donald Trump's new media startup. He's a fervent supporter of the former president. He possibly faced a tougher path to re-election next year. Draft maps by the state's redistricting commission showed his district becoming more Democratic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
To cut emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
All of us, whatever our background, our age, where we live, we can agree that prescription drugs are outrageously expensive in this country. Doesn't need to be that way. Under my Build Back Better bill, there will be, which is passed the House of Representatives, it won't be the same way.
The President of the United States there from New York City this morning. Good morning. Tom Keene, Lisa Bravitz and Jonathan Ferro. Your equity market with a lift, a rally, 61 basis points, 61 points higher on the S&P. We're up by 1.3%. On the NASDAQ 100, advancing 1.8%, advancing on a 10-year Treasury yield by about half a basis point to 143.76. Crude with a 71 handle at 71.51, advancing there 2.9%. One stock to watch in the pre-market. Switch up the board and get to Apple. Apple in the pre-market looks a little something like this, up 1.85% to 168.38. You mentioned that call from Katie Huberty, Tom, over at JP Morgan. Rates Apple overweight, goes to $200 a share, in line with the big bull on the street, Wedbush's Dan Ives, also at $200 a share. Right now, Tom, 168.
168. It'll be interesting to see. Thank you for that. Right now, in the studio with us live, Joe Matthew. Of course, he holds court at 5 p.m. worldwide on Sound on Bloomberg Radio and other points of the digital space, and joins us here on his Washington. There is a photograph from long ago, another time and place, not of Senator Dole, but of Howard Baker, and I believe a gentleman in white hair from Boston named Tip O'Neill, and a guy named Ronald Reagan. And they couldn't stand each other, but they got things done.
That's right.
How far are we from Tip O'Neill and Ron Reagan?
Boy, we're a long way. A lot of folks were asking that about Bob Dole. You know, what did we lose when we lost Bob Dole? And it was another era here. We don't have a lot of Bob Doles or Tip O'Neills, although it's interesting. I still maintain that these guys get along better than you might suggest when you see them on TV or when they're laying down talking points. If we're getting to the president's spending package here, though, it's not something that's going to be passed through in its current form. I think that we're asking a lot of questions about a process we know little about in a bill that's going to come back looking very different than it was when it went over there.
Is the process linking defense, which everybody's on board with, with the shutdown of the budget, the debt issue?
The debt limit.
Yeah.
Specifically on the debt limit, yes. And they don't have a lot of time to figure this out. I would ask you guys as well, how come the markets aren't freaked out about this yet? It's because somebody expects a deal, right? Mitch McConnell and Chuck Schumer have been talking. We don't know exactly how this is going to end, but we don't have all the bluster. Mitch McConnell isn't warning Democrats to get with it here and avoid a default, because there's likely going to be something that comes together. It looks like that defense spending bill, and it looks like there might be language from Mitch McConnell, based on what we are hearing, that gives authority to the president. This has happened before, to handle the debt ceiling on a short-term basis here. That means Democrats don't have to put a price tag on it. They don't have to put a duration on it. Everybody gets what they want. And Democrats have an opportunity to dare Republicans to vote against funding the military while this debt ceiling is in that package. That's something that probably is not going to happen.
We double dog dare you. Perhaps it has extra emphasis when we have this call that's going on between the United States and Russian President Vladimir Putin today, the focus really being on that troop buildup on the Ukrainian border. How much can Europe really prove an ally for President Biden, especially given the gas crisis, especially given its more tenuous geopolitical stance in Germany and elsewhere?
Well, it wasn't lost on us that President Biden actually held calls with our European allies yesterday. They had a little bit of a summit ahead of the conversation with Vladimir Putin, just to look like they're all locking arms here. But, you know, when we talk about the individuals here, the personalities, that's when this gets a little bit more interesting. Who wants what? Who's trying to get what? If your name's Vladimir Putin, you already got a lot of what you want. It's called this meeting. It's the fourth go-round for Putin and Biden, something most world leaders could not say at this stage of the game. And look, Vladimir Putin's looking at the calendar here saying it was 2014, right? Crimea. Does anyone remember Crimea? Well, there was a lot of tough talk about that, too. And I'm not sure that he believes a lot of the bluster that he's hearing from the West, that the military could actually get involved here if there was an invasion of Ukraine. Well, no. But maybe that's not what they're doing. Maybe this is all about leverage to get a meeting like this and more negotiations with the U.S.
Joe, that's a really interesting interpretation, especially given some of the rhetoric that we heard around former President Trump. I do, though, want to to pick up on the point that, markets are not particularly fazed by any of this, and you're not seeing a dramatic move in the ruble either, even though one of the potential consequences could be to make it difficult for Russia to transfer their rubles into dollars. Do we have a sense of how heated this meeting is? Is it really just a win for Vladimir Putin to be seen on the same stage with the president of the free world?
Well, that's, I think, the way Vladimir Putin is looking at it. The burden is on Joe Biden to turn this into something else. And he is going to talk tough, as we're told. He'll be explicit about those potential sanctions. He'll say that there is a red line here. And Vladimir Putin will likely sit back and chuckle because, well, that's his personality. And he's heard this before from the West. So I think it's going to be upon the Biden administration to prove, Lisa, that this time is different.
Hey, Joe, good to hear from you, and looking forward to the show a little bit later. In New York, Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern. Joe's in New York through most of this week. The Europeans are unhappy with one element of the Build Back Better Act. It's the plan to offer an additional $4,500 in tax credits to consumers who buy cars made by U.S. manufacturers with union-represented workers. And this is what the Europeans have got to say on it, Tom. The tax credits would result in unjustified discrimination against EU car and car component manufacturers. This is from Valdis Dombrovski, a man that joins this program sometimes. I very much hope that it will not lead to unnecessary friction or create new barriers in the transatlantic relationship. Some friction there, Tom, between the Europeans and this administration.
Announced yesterday, $1.x billion lithium battery plant in the Carolinas by, I believe, Toyota. That's what the foreigners are doing in the South. And do you want to, meet the politics of the moment? And President Biden certainly has to confront a huge body of the Democratic Party on that. Or do you want to read on the Bloomberg terminal about $1.x billion invested by Toyota in the Carolinas?
To be clear here, that's what the foreign companies are doing. BMW's been doing the same for a long time in this country. Do you think the foreign governments are happy that that's where some of the investment is going, potentially, Tom, in the future because of rules like this?
It's one form of globalization, and we're all dealing with it. But the answer is we've got such competing interests here to try to get some form of legislation through. I like, frankly, what a number of people are saying, which is all of this gets delayed into next year.
Elon Musk, another man who's unhappy with this particular element of this bill, Lisa.
That, to me, is fascinating because his company actually benefits from the electric vehicle credits that you get. But he basically is saying he thinks that those should be stripped away. Also having some of those benefits stripped away for the gas and oil companies as well. The idea here is the deficit. He doesn't want to see the deficit increase. Fascinating from the leader of a company, an auto company, that really stands to actually be one of the bigger beneficiaries.
I believe it's also the union represented element of this particular ruling as well, Lisa, that he's unhappy about. Do you remember the EV get-together they did at the White House? Where was Tesla?
He doesn't seem to have a great
Tesla wasn't there. Yeah. Some tension between him and a lot of people. Futures up by 58 on the S&P, advancing about 1.27%. There's a lift in this equity market this morning. There was a lift yesterday and some positive follow-through into this morning's session. Good to have Lisa back alongside Tom Keene. I'm Jonathan Ferro. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also, we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
What a powerful start to the week so far. From New York City this morning, good morning. We add some weight to yesterday's rally on the S&P up 60, advancing 1.3%. On the Nasdaq 100, up by 1.8%. Of the small caps with a lift too, up 37 on the Russell, advancing there 1.68%. This equity market Monday through Tuesday rallying quite aggressively then. In the bond market, this is the story for you. 2s, 10s and 30s switch up the board. We look like this. 2-year yields back to the highs of the year. 65 basis points on a 2-year, up 2 basis points. That curve flatter. The distance between 2s and 10s in and around 80 basis points, I think about 78 right now. 143.76 on 10s, unchanged there. And looking ahead to December 15th with a clear view of things. As we understand it, for the Federal Reserve, a decision on bond buying is separate from a decision on rate hiking. And typically, we expect the bond buying to end before the rate hikes start. Got it? Okay. The ECB might have a different idea of that process. One ECB official specifically. Switch at the board and finish on euro-dollar. Euro-dollar looks like this morning, negative 0.2% at 112.62. Governor Holzman, Tom, suggesting in the last 24 hours, and I'm not saying this is going to be a consideration for next week, might be a consideration through next year, that maybe the ECB can make a move on rates even when the bond buying hasn't ended. That's a confusing one because that's not the process. The sequencing is the right word. It's not the sequencing, Tom, that we're used to.
I'm really glad you bring this up, John. This is a raging question in academics, and really it's almost an optimization question, John. What's the optimally most constructive way to get back to some form of neutrality? It's a huge theoretical question.
And bear in mind, we're at negative 50 basis points in Europe with an inflation rate, what is it, Tom, in and around 4%? On headline.
And it's less than what we've got here.
4 or 5.
What we've got here is Morgan Stanley top tick out at 7.1%. And on we go down by the tenths of a percentage point. You have to slice and dice that as well. Lindsay Piegza joins us right now, chief economist at Stifel. Lindsay, you're a little bit below all the excitement. How much is a tenth of a percentage point in an inflation call? Is that a big deal right now?
It's really not. I think right now the market is very much focused on the momentum that we're seeing in inflation, with the expectations for Friday's report that the headline does continue to move towards 7%. The core continues to move towards 5%. So even if you're a PCE fan, a PPI fan, regardless of your favorite inflation metric, I think right now the market is focused on the fact that prices are moving higher, and the Fed has now conceded that the word transitory needs to be retired.
What? Okay, we can't retire the fact there's a fear about a boom economy. What are the bad outcomes to America of having a China-like 9% nominal GDP?
Well, there's nothing net negative in terms of the economy growing at a faster pace, but we have to look at the composition of the underlying growth. Is this organic growth, or is it temporary growth spurred by out-of-control government outlays? And so that's really what we need to focus on when we're talking about the growth prospect. At the first half of the year, we saw much more robust 6.5% GDP, but most of that was spurred by trillions of government spending. In the back half of the year, we're now likely to see about a third of that activity. But again, much more organic and arguably then much more sustainable as we turn the quarter into 2022.
What is trend growth, Lindsay, and is that where you expect to get to at the back end of next year?
I think trend growth returns to 2% as we look out to 2022, which is disappointing relative to 6.5% again at the first part of this year. But remember, we're simply getting back to pre-pandemic levels of activity. We tend to romanticize where the economy was prior to COVID-19, but we were already losing momentum. If you remember, 3% in 2018, down to 2% by the end of 2019. So going forward, as the economy stabilizes, it's likely that we do return to that more anemic, but again, more organic 2% growth.
This is crystal ball type stuff, so forgive me for going through next year in any kind of way that involves precision. But I just wonder when it starts to become obvious that that's going to be the trend through next year. There's a conversation now, Lindsay, as you know, that we're going to accelerate the taper. Maybe it ends in March of next year. And then people are talking about rate hikes through the summer. If we're going back to trend, does that start to become evident in the middle of next year? And what does that mean for the rate hike conversation?
I think it does become evident in the middle part of next year. And for the rate hike conversation, I think the Fed is delicately balancing the fact that, yes, they want to quell inflation. Yes, they want to keep inflation expectations in check. But the committee also recognizes that the economy is still very fragile or maybe increasingly dependent on the monetary policy punch bowl. So while they are likely to initiate liftoff at an earlier timeline than previously expected, the ascension to the cycle peak is likely to be very muted, very slow. And that cycle peak could be, what, 2.5%? So we're still talking about historically very accommodative levels for the market.
Well, and that's really what I keep wondering as I take a look at the 3 rate hikes that are baked into the market assumption through the beginning of 2023. Can the market withstand that if the economy is slowing down in tandem?
Absolutely. We're starting from 0 levels. So even if we talk about 2 or 3 rate hikes, we're talking about 50 to 75 basis points. Still very accommodative policy for the marketplace. And remember, the economy is no longer in these emergency conditions that the Fed found it appropriate to lower rates to 0. We're no longer in the height of the crisis. So it is very appropriate that the Fed would not only initiate taper and talk about potentially ending that taper sooner, but that the Fed is very much focused on removing these emergency types of accommodation, getting us back to not even neutral, but just less accommodative policy.
In the meantime, Lindsay, how much do you care about Omicron?
I do from the standpoint of what is the policy response, because health implications aside, the impact from an economic standpoint is less about the virus itself and more about the policy response. If we see a return of the very onerous restrictions that were implemented during 2020, we could very easily put ourselves into a second round recession. But if in fact we see more of a minimalist approach, as we saw to Delta during the spring and summer months, well, it's very likely that the economy remains on positive footing and we continue towards this longer term potential stable rate of 2 to 3% GDP.
Lindsay, for you to get back to 2-3% is a run rate here. This is not China. I mean, it's a boom economy, 9% nominal GDP, but the portion that is real is so much smaller on a proportional basis than what China experienced as well. Have we ever dealt month to month, and has business ever dealt month to month with such an odd skewing of the makeup of our nominal GDP, of our animal spirit?
I can't think of one on record. This is certainly unprecedented territory. But to be fair, I think this is to be expected in the aftermath of a global pandemic. Excuse me. We're working through a number of unprecedented conditions, be that trillions in government stimulus to unprecedented supply chain disruptions to a 10 million job vacancy or labor shortage in the marketplace. So there's a number of structural issues
that are complicating the picture.
You have a huge advantage at Stifel, unlike, this firm or that firm or another firm, in that you got your ear to the ground of America. What do you hear from business clients of Stifel?
I think we hear a number of frustrations. Businesses are desperate to get back online, expand production, get back to pre-pandemic capacity, but they're facing shortages of materials, parts, labor. So all of these variables are really compounding the difficulty for businesses to get back to, quote, normal, which is, I think, prolonging the reliance on artificial policy measures, both from a monetary policy standpoint, but also from a fiscal policy standpoint. Remember, we're still talking about roughly 7 million Americans reporting a position of unemployment. Some of that reflects this ongoing elder care, child care issues. Some of these reflect lingering issues from earlier fiscal policies. Others are simply concerned about the ongoing impact of the virus. So there are a number of issues that are going to continue to be with us, prolonging this disconnect, this inadequate return of balance, excuse me, to the marketplace for some time. There is no quick fix here.
Lindsay, it's going to take longer and longer and longer. We've been saying that now for 18 months. Lindsay Piegza, thank you. Chief Economist at Stifel. Secretary Yellen weighing in on this at an event with the FT, saying some shortages will take a couple of years to resolve. The labour situation is very unusual. You remember the end of the summer, Lisa, when Goldman put out that note pushing back the full service sector recovery. And we were thinking, OK, after September, we're going to have to wait. We'll figure things out. People go back to school. People can go back to work. And now we're talking about when? Back half of next year.
Are we even really trying to game that out? Or are we just going to know that this is going to be persistent? But what does the Federal Reserve do with that? What if they know that we're going to get these supply chain shortages? If we have labor market shortages, do they raise rates? Is this something that the Federal Reserve can and should combat? And I think that this makes their job very perilous heading into the back half of last year, as we hear from a lot of analysts who are saying this is why there's going to be so much volatility.
Well, there's been a change, hasn't there? Just in terms of how they wait this out. They're not going to wait anymore. At the start of the year, if we had this conversation, we'd say the Fed will remain patient. They have a new reaction function. They're willing to wait and look through all of this. And that doesn't seem to be the case anymore. And I think that was really captured by what Ellen Zentner of Morgan Stanley said to us on Friday, that the risk around the Omicron variant, if any, for the Federal Reserve, is that they go earlier, Lisa, not later. Now, if we'd had that conversation 12 months ago, I think the conclusion would have been different.
Especially because when you talk about the emergency accommodations by the Federal Reserve, it's in response to the virus. So another surge in viral cases causing actually a tightening is really interesting. I will say going forward, how they respond really will determine also will be in tandem with how much the economy slows down. If you do see the dynamism of the consumer on the heels of those checks that were passed out to everyone, then they will have more incentive to go ahead and raise rates, even if the overall economic growth seems to be tapering down.
Access to labour is just a massive issue, Tom. Your Spurs might not even be able to play their football game.
Yellen's talking about inflation, the concern of the day. For Tottenham, the concern of the day is idiots. John, do you assume that they're unvaccinated,
I
these
don't know,
players
Tom.
for Tottenham?
Tom, I don't know. I know that's been a big story in sport over the last year or so, but we've had so many breakthrough cases, I'm not going to assume anything. But there is an outbreak at the club.
I mean, I hope Harry's okay.
As I understand, Tom, they can apply to postpone the game they've got against Brighton. They can apply to the Premier League to do that. I'm not sure the same stands with UEFA. Any Europa League game has to be played. I believe if they have more than 13 players or more from the A-list available. So we'll see, Tom. I think they've got to get PCR tests now, haven't they?
I don't know. I don't understand these sports guys unvaccinated. I just don't get it.
Yeah, I don't get it either, Tom, but on this particular occasion, I'm not sure if that's the case, and I'll wait for some confirmation of that. Up 62 on the S&P, advancing at 1.36% on the S&P 500, a rally in this equity market. From New York, this is Bloomberg.
With the Fast Word News, I'm Rishka Gupta. President Biden will warn Vladimir Putin today that Russia would face severe economic penalties for invading Ukraine. The two leaders will have a video call. A senior administration official says that the president also will tell Putin there would be benefits if he makes a commitment to diplomacy. China warns the U.S. it will pay a price for its diplomatic boycott of the Winter Olympics. The Biden administration has decided not to send any officials to February's games in Beijing. China's foreign ministry says The Olympics are not a stage for political stances or manipulation. And in China, exports and imports unexpectedly set records in November. Exports rose 22% in dollar terms, whilst imports grew 32%. The data showed the continued global demand for Chinese goods, which has been strong through the pandemic. And Bloomberg News says it will continue to do all it can to help Staffa Hayes-Fan and her family 1 year after she was detained in China. Editor-in-Chief John Micklethwaite says 12 months of detention is a long time for anyone to endure and that the company remains very worried about her well-being. Chinese authorities have said Fan was detained on suspicion of national security law violations and that her legitimate rights and interests are fully guaranteed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishki Gupta. This is Bloomberg.
Do you ever commune with Conrad Hilton? Do you ever get any messages from heaven from him saying you're doing a good job protecting my name?
I haven't, but I did meet his son Baron. He was quite proud of what we had done with the company and suggested to me Conrad would have been as well.
Up front, when your shares are down 20%, it's going to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
early indications is you're not seeing so many people going to the hospital very sick. On the other hand, we are seeing information that it is very transmissible even among people who are vaccinated. So we're going to have to just keep waiting for the information to come in.
That was Joshua Sharfstein there on the early conclusions. I stress early conclusions so far on the new variant. The Vice Dean of the Johns Hopkins Bloomberg School of Public Health from New York City this morning. Good morning, Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market with a lift from yesterday, some positive follow-through into Tuesday, up by 63 points, advancing 1.4% on the S&P. Yields pretty steady at the back end on 10s at 143.59. Crude with a rally of more than 3 percentage points to 71.78. And here's a single name for you in the pre-market, American Airlines succession planning. Announcing that succession plan just moments ago, the stock up by 2.8% to 18.43, announcing that Robert Isom is to become the CEO, was the president, Tom, set to become the CEO on March 31, 22. And of course, Doug Parker, the chairman CEO, Tom, he will retain and continue as the chairman.
And grizzled with great experience in the trenches, the visibility is customer service, but it's much more than that with U.S. Airways and with America West Airlines, excuse me, I would say. He's out of Notre Dame in Michigan, and, it's a typical structure that you would see for an airline executive in the modern era.
Can we talk about customer service, Tom, in the sky right now? That relationship is just broken down.
Yeah.
Between the people that work for the airlines and the people that fly right now. It is broken.
Our personal soap opera here that Lisa and I are living, as well as we're catching up with John Farrell. John, you've been living this for 18 months, I'll say. And I've got a renewed respect for what you and many others flying out of Heathrow have had to put up with.
Tom, there's a tension right now between the people who work for the airlines and the people who fly on the airlines. Obviously, away from the extreme stories, which are absolutely ridiculous, where there's been violence on the planes, and there's absolutely zero support from anyone for any of that. But anyone flying right now, Tom, has felt that tension between the people who work on the airlines. And with me personally, I've found it too. Over the mask, Tom, very, very aggressive over the masking. And they've been put in a very unfortunate position where clearly they feel at risk on the airline themselves, and they feel like they also have to enforce these policies too. And it just creates this natural tension, Tom, that is there. It's kind of the elephant in the room when you fly right now. It's just how delicate things seem to be between the passenger and the airline staff.
It's a pandemic, but I'm going to say, John, this is a real leadership exercise, and everybody's got their own anecdotes. I'll give a plus to Delta. That happens to be my experience. But we were talking about JetBlue earlier. John, you and I got in at 5:50, and Lisa was already talking up JetBlue because she was in at 3 a.m.
Well, I'll tell you the biggest misconception about JetBlue on either side of the Atlantic, and as they start that new entrant into that corridor, Tom, over the last few months, the misconception that they are like the Ryanair of American Airlines, and I don't think that's right. And I think that misconception also exists to some degree in the United States, Tom. I don't see them as a budget airline per se. I think their Mint offering, the Mint cabin, has been absolutely fantastic.
To add value off of Bloomberg surveillance, Helene Becker with us a few days ago from Cowen with a real great interest in United Airlines. We are united in the value, and Amesh Adaljo has given us, he's senior scholar at Johns Hopkins and truly in the trenches on this pandemic. Amesh, I began the show by suggesting that the lift in the market 2 days in a row, there's this, and it's one single news article that says Omicron tilts towards being a cold. What say you about the present research on Omicron?
It would be great if it tilts towards being a cold, but I don't think we can say that with certainty yet. I think there's a possibility that that may be the case based on some of the early case series that are coming from South Africa, that we're not seeing as many people being hospitalized, as not as many people needing ICU beds or needing oxygen, and a lot of people getting picked up incidentally when they're in the hospital for other reasons. That's all reassuring. But we need more data to be able to say that with certainty. And we also need to see what happens when we extrapolate South Africa's experience to countries that are older, like the U.S. And it's also the case that the U.S. has more vaccination. So this would be a great thing. I think all of us are cautiously optimistic. It's interesting because it all seems to be converging upon this consensus. And that's a good thing because we're not seeing outliers of severe disease yet. I suspect we will see it, but hopefully this is kind of the step that the virus takes to become something that we deal with more frequently on an annual basis, that has the ability to get around our immunity but not make us too sick. But I think we still have to wait for a bit more time.
What is your waiting to the calendar, to the fact that there are waves to the autumn and into winter, whether it's a cold, the flu that amateurs would call it, what's the weighting of the seasonality versus all our other fears?
Well, I do think that coronaviruses are going to ultimately end up becoming seasonal because all of the other ones do. This one just takes some time to get to seasonality because there's not enough immunity in the population. But I do think we will see intensification of spread when it gets colder, when people move indoors, and when spread of the virus is more efficient. It's just going to take some time to see that complete stark seasonality. Right now, we do see some seasonality, but there's still transmission going on in the summer because there's too many people that were not immune.
Given what we know about Omicron and what it can do getting around certain immunizations, whether it's vaccinated individuals or people who've been previously infected, what does it mean to be fully vaccinated? Does it mean a booster shot as well?
Well, I think you have to remember that vaccines are not all or nothing. It's not an on and off switch. There's a spectrum of protection that they provide. And even if Omicron is able to get around some of the immunity, which is what likely the case, it's not able to get around what matters, protection against serious disease, hospitalization, and death. And when you think about boosters, to me, the threshold has always been preventing serious illness, hospitalization, and death. And that's why I'm somebody who thinks boosters belong to people that are above the age of 65, high-risk conditions, those who got the J&J vaccine. For the healthy population, it's a little bit unclear whether they're needed or not, even though the CDC updated their recommendations. And there is some controversy in the field. There may be a need with Omicron to make an Omicron-specific booster, and then that's a little bit different. But these first-generation boosters, I think in a healthy population, you're just really pushing off a breakthrough infection sometime in the future. You're not really giving a great amount of protection in terms of what it actually gives you. But if you're older or have a high-risk condition, yes, there's definitely clear benefits there.
Dr. Adalja, before we let you go, I'd love you to weigh in on the mandate in New York City now that all private sector employees get vaccinated. Is this the course of travel that you expect not only in New York City, but around the country and around the world?
I think it's going to be certain cities that try and do this. It's interesting because New York City already has one of the highest vaccination rates in the country. It would be great if that was going on in parts of the South where the vaccination rates are low. But what we'll find probably is some states that are already highly vaccinated are going to become more boosted and more highly vaccinated, while the rest of the country kind of languishes at that lower rate of vaccination, like West Virginia, 41% fully vaccinated. So I think we're kind of still in that two-track pandemic. But I think that because the OSHA mandate predictably got tied up in courts, you're going to see local municipalities and states try the same thing.
Doctor, thank you, sir. Always enjoy catching up with you. In fact, love it. Dr. Amish Adalja of Johns Hopkins. Lisa, just on that final point, do we know whether Mayor Bill de Blasio consulted with Eric Adams? Because on your way out to do something like that,
yeah,
a bit curious, isn't it?
Actually, I was wondering why Mayor Bill de Blasio is doing that now, why he is doing this before he leaves office, just months before he leaves office. At the same time, a lot of people say the big city's future really rely on the virus getting under control. So it seems like he likely is doing the dirty work, frankly, for Eric Adams.
You just can't escape the politics of this, can you? Does someone want to make a run to be the governor of New York, trying to position themselves just a little bit more?
All right, I'll let you put that out there. Let's see whether he would win.
Many other people have put it out there.
Is there any chance he would win? I mean, come on, let's be honest.
Not here to guess on the politics of New York.
So what happens is that we create some icons, we call them tags, and they have a signal within them. and when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command for whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, I don't know, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the Q3 was the quarter that was most affected.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed always gets what they want. And so if they want tighter financial conditions, they get that.
They worry about inflation expectations getting out of control.
The risk around Omicron is that the Fed has to hike earlier, not later.
The tricky thing for the Fed is that they're most likely to be hiking into a slowing economy.
The market's really not confident that the economy can handle higher rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Here's the bounce from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market up another 60, Tom, advancing 1.3%. We add some weight to yesterday's rally.
And it's a different characterization. Yesterday I thought was really led by Dow. There was a fade at the back end, but the Dow led the way. Today, guess what? NASDAQ 100 catches up. Some of those big names moving up. Katie Huberty at Morgan Stanley goes all Dan Ives and calls $200 on Apple. Maybe that's the headline sell-side piece today.
Street high price target on Apple. We can discuss that a little bit later. Some numbers, some data, Tom, from Glaxo and their joint effort to deliver a vaccine. Phase 3 trial data. Here are the numbers. 75% efficacy against the highly infectious Delta variant. Nearly 89% efficacy against the Gamma variant, first identified in Brazil. And still to be seen, Tom, as to how it stands up against Omicron. That data's still to come. They plan to test the vaccine against that in the future.
I'm going to deal with a great pharmacologist we've got at Bloomberg, John Lauerman as well, in Bloomberg News. And I'm confused by all these different vaccines, John, other than to know there's an urgency to distribute them worldwide.
Some urgency and some early conclusions as to what Omicron might mean going forward, Lisa.
Yeah, especially as people struggle to understand whether the issue is just getting sick or whether the issue is going to the hospital. Two different issues. And what you're seeing is when is there going to be a shift in emphasis from illness to severe illness and actually allowing COVID to just be another one of those things, not have to necessarily quarantine for 2 weeks.
Glaxo up about 1% at the moment, just in reaction to that. Tom, let's talk about where this market is. This market is what? 2% away from all-time highs on the S&P 500. You and I keep going back to this, TK. It has felt so much worse than this. The index is down 2%. From all-time highs.
Well, you know, Liz Ann Saunders with us later. A very strong equity show today, folks. Stay with us, Global Wall Street, for Liz Ann Saunders, and then Edward Yardeni to join as well. And what they're both going to say, John, is the breadth isn't there. And what the bulls are going to say is, so what? and it's a huge issue right now, the so whatedness of equity markets and the buy the dip.
Lisanne coming up a little bit later. Looking at the bond market, Lisa, 10-year yield 143.25. Unchanged there, a lift at the front end, twos at 65.
And that's where I wanted to go. That frankly, the rally that we've seen has not been a very nice rally in terms of how it's made people feel, because it has not come in tandem with people upgrading their expectations for growth, for necessarily the outlook for the U.S. economy. Today, Goldman Sachs is holding a two-day U.S. financial services conference. I really want to hear what these CEOs have to say. David Solomon, Charles Scharf, Brian Moynihan, and Q-Sing Lee of the Carlyle Group. Really interesting to see whether they see loan growth increasing, what they're penciling in terms of rate hikes, and why they can explain, how they can explain why their shares have underperformed so significantly. At 10 a.m., President Biden is having a video call with Russian President Vladimir Putin over Ukraine's sovereignty. How much will this be a summit for Vladimir Putin to feel like he's on the same page with the U.S. president? How much can they actually come to some sort of consensus that prevents an invasion of Russia into the Ukraine as they build up troops on the border? And at 1 p.m., Tom, this is for you. U.S. Treasury is planning to auction off $54 billion of three-year notes. This is where it gets interesting. Two-year notes at the highest level going back to March of 2020. Rate hikes baked in for next year. But what after that? How quickly do rates rise, given the fact that we are expecting the Fed to hike into a slowing economy, John?
$36 billion of 10-year notes coming tomorrow. And Lisa, I know you get excited about the 30-year. That comes on Thursday, $22 billion.
Cancel everything.
Gets Lisa excited. Tom's half asleep. In fact, Tom, you're away Thursday, Friday. So you're taking those 2 days off. Your yield curve right now, 78 basis points, twos versus tens. We've seen some flattening. We saw a massive rally on Friday off the back of a labour market report that most people assumed said was good, it was decent. Ian Lingen joins us now to explain it all, the head of US rate strategy at BMO Capital Market. Ian, let's start with a question I know you've been facing with clients again and again repeatedly over the last week. Why is this yield curve flatter, flatter, flatter?
Well, I think that what we're seeing in the Treasury market at the moment is a reflection of both this notion that the Fed is going to be hiking into a slowing economy, and that does have ramifications for forward inflation and growth expectations. But there's also a positional aspect here. We all came into the beginning of this year expecting a cheaper and steeper yield curve. People have been positioned short further out the curve for quite some time. And frankly, the pain trade is to lower rates and a flatter curve. And as positions are unwound into the end of the year, it's going to be a difficult trend to fight. We're still expecting that there's further flatness to be realized, particularly in 5s, 30s.
Is there a bet in this market, Ian? To amateurs like me, it's just one day this way, one day that way. Who's going to place capital? Is there a bet into the end of the month, into next year?
I think that one of the biggest wagers in the market at the moment is whether or not the Fed can engineer a soft landing. If we look historically, central banks don't have the best track record of putting the brakes on the economy just the right amount to take the edge off of inflation. And so when we look at the major debate, the major debate is, will the Fed tighten us into a recession, and is a much flatter yield curve warranted? I think that's the biggest question for next year, frankly.
I asked this question earlier in the day, but to me, this is what I keep hearing among traders. How much is this a liquidity issue? How much is this a move as people try to immunize their portfolios from volatility heading into year end, people piling into long-term treasuries as that hedge, causing yields to go down and this yield curve flattening that doesn't necessarily cohere with an economic outlook?
Well, I think to a large extent, that is what is going on. We have a relatively illiquid market into the end of the year, very typical. We have people who have reduced positions already, given the lack of performance throughout the last several months. And it follows intuitively that this should then exaggerate some of the price action. That said, I wouldn't be so convinced that this is only liquidity, because liquidity can lead to the first few rounds of stop outs, and then what we'll see is a capitulation. So liquidity, capitulation, and then in January we reset and try to do it all again.
Ian, with that in mind, how do you expect market conditions will evolve as the Fed pulls back and pulls back faster?
Well, I think that we'll see less of an issue in terms of liquidity in the Treasury market per se, and more concerns with other markets. Obviously, some of the high yield markets come to mind, some of the more credit heavy, less normally liquid markets, I think will be an easy touchstone for people who are concerned with gauging what happens when the Fed pulls away. But ultimately, at the end of the day, I think the Fed is very focused on financial conditions, and so any increase in equity volatility as a result of a correction in stocks will be the Fed's focus and could lead to another pivot in the event that they end up doing more damage to financial markets than they're expecting to.
Ian, final question from us. That tolerance for financial conditions tightening, has that changed given where inflation is now versus where it was, say, 2 years ago?
I think that the Fed can absorb and justify continuing to hike given a 15-20% pullback in equities in the event that it's orderly. The Fed runs up against an issue when such a correction ends up being a lot more dramatic and occurs quickly, and that would tighten financial conditions even more. So to some extent, they are just as sensitive as they have always been, but the flip side being we're starting from an extremely easy financial conditions start point. So I think that that's something to keep in mind. They do have some more flexibility than they might have 2 years ago.
Ian, thank you, sir. As always, thank you very much. Ian Lingham there of BMO Capital Markets. And Tom, when we talk about tighter financial conditions, that is code for an equity market that is lower. And when Ian talks about orderly and disorderly, we're talking about a credit market shutting down in December 2018, disorderly because the primary market closed up in high yield. Orderly, Tom, would be issuance continuing and equity market grinding lower in a way that maybe they just have to tolerate because their focus is on inflation right now.
1 year ago, 2's10 spread, the vanilla spread, the difference in yield between the 10 and the 2, 78 basis points, 0.78 percentage points. Today, 78 basis points, 0.78 basis points. What percentage of people did we talk to a year ago who were certain we'd see steepening?
They got it for a quarter. 157 basis points was the steepest we've seen this year.
Exactly.
It was the end of the first quarter, Lisa. It was the end of the first quarter. That's where it all topped out.
Well, and this is the reason why people have actually been caught by surprise at some of the strength in credit markets. And I really want to go to what Ian Lingham was saying about possible distress in credit markets. You've seen the beginnings of some concerns there recently with respect to trading in derivatives markets and outflows. And I do wonder at what point that becomes destabilizing. That tends to lead. And we are seeing deals start to get pulled from the market, given the fact that conditions are not as easy as they were earlier in the year.
Tom mentioned breadth. We've got to talk about breadth in this equity market, the churn beneath the surface, how many stocks are suffering beneath the surface and what's holding us up. Tom, the resilience of the index this year through 2021, the fact that we haven't had that correction that Morgan Stanley were looking for, that Bank of America were looking for. And again, given everything we've thrown at this equity market in the last month or so, Tom, as we keep repeating, it's 2% away from all-time highs.
And I would note that a lot of the skew, if you will, or the jolt that we had, John, was energy give back, moving from $84 Brent down to $75 right now, and also in the banking stocks as well. If they were to recover, you get right back to a better breadth.
Lizanne Saunders is going to weigh in on this a little bit later. Ed Yardeni, fantastic on it as well. Looking forward to catching up with the strategist over at Yardeni Research. Your equity market looks like this, up 59, let's call it positive 60, up 1.3%, adding to yesterday's rally. At the bond market level on a 10-year, yields are unchanged at 143, on twos at about 65 basis points. Down in Washington, an important video conversation taking place a little bit later this morning between the President of the United States and Russia's leader. We'll get you some coverage on that in just a moment. From a beautiful morning in New York City, good morning. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. The US and Europe are considering tough financial sanctions against Russia if Vladimir Putin invades Ukraine. Bloomberg's learned that Russia's largest banks will be targeted, along with the country's ability to convert rubles into dollars and other currencies. President Biden may spell out the sanctions today when he and Putin have a video call. Russia has denied it plans to attack Ukraine. A new coronavirus vaccine has shown 71% effectiveness against multiple variants of the disease. The shot was developed by GlaxoSmithKline and Canada's Medicago. According to trial results published today, no vaccinated participants developed severe disease and no serious side effects were reported. The shot will also be tested against the Omicron variant. And the UK is moving forward to increase trade with individual states, and it's ready to resume talks with Washington on a broader federal deal. British Trade Minister tells Bloomberg discussions are set with California, Georgia, Tennessee, South Carolina, and Oklahoma. She meets with U.S. Commerce Secretary Gina Raimondo this week. And a leadership change at American Airlines. CEO Doug Parker is stepping down at the end of March after more than 8 years in the job. He'll be succeeded by American's President Robert Isom. Parker will remain chairman. The United Arab Emirates will move its weekend to Saturday and Sunday in an attempt to draw in more business and investment. There will now be a 4.5-day work week. Friday, which is a holy day in Islam, will be a half day. The Gulf nations currently have a Sunday to Thursday work week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
While India might be securing jobs for its highly skilled elite, complicated, uncertain taxes have pushed most foreign companies in need of cheap labor towards China. That's costing the economy an estimated $140 billion a year.
They've been saying they're open to the rest of the world, but there are still a lot of protectionist barriers on doing business with India.
To follow in China's footsteps and reach the government's goal of being a $5 trillion economy by 2025, India needs to create a model which succeeds both at home and abroad.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Do you think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It might be better if the bill doesn't pass, because we've spent so much money. It's like the federal budget deficit is insane. Something's got to give. You can't just spend $3 trillion more than you own every year and expect, don't expect something bad to happen.
Elon Musk, the CEO of SpaceX and Tesla, I think it's fair to say there's some daylight, some distance between Elon Musk and this administration. We can build on that in just a moment. From New York City this morning, good morning. Tom Keene, Lisa Abramovich and Jonathan Ferro. Your equity market up 60 on the S&P, advancing 1.3% on the NASDAQ 100. Just off session highs, but a sizable rally here, up 290, 289, positive 1.8%. Yields unchanged on 10s, Tom, at 143.59. On crude, we advanced 3% and some to 71.65 on WTI.
Interesting market here. And again, we should, and John, I think you and I have been remiss here. We have not really emphasized Friday's important with that inflation data.
CPI coming up, Tom.
Basically waiting for
I believe 6.8% is the median estimate. 6.9 is the view out of Wells Fargo, and they're looking for 7 in Q1 next year.
We talked that up big yesterday. Right now, what we're going to do is dodge to Washington. I'm going to go philosophical. I don't know where John and Lisa go. Somebody asked me, do you guys rehearse the questions? We absolutely do not. I have no idea what John's going to say. I know Lisa will mention auctions. That's understood. But other than that, I have absolutely no clue. Terence Haynes joins us right now, founder of Pangea Policy. We're thrilled he could be with us. Terry, I got a philosophical question, and I don't want this to be political, like Trump, pro-Trump, or Democrat, Republican. In general, what's the new corruption of money in Washington? I noticed one story of somebody raising $14 million out of the blue for one cause, or I've got the congressman from California going over to do a SPAC with a former president, and on and on. What's the character of the corruption of money that you see in your modern Washington?
I think, Tom, what it is there hasn't been any revision to the campaign finance laws in almost 50 years. So what you end up with is a torrent of, kind of water going through the cracks on a variety of things. And what you get is an awful lot of hands-on or arm's length transactions that certainly comply with the letter of the law, but are questionable in the spirit. And there's all kinds of stuff from the, and again, not partisan, but as you say, but, people investing in things to people involved in a variety of different business transactions to friends of friends of friends. Yeah. And it's all, and it's all very indirect, but it doesn't keep the character of the country's, the country's representatives in good repute.
And now a dumb question for the day. We can do that with Terry Haynes. I'll ask a dumb question. He'll give a smart answer. If they raise money, like a given 100,000 or a given 5 million, do they get to keep it when they're done serving the public?
Yeah, by and large they do, and they use it to continue to have some influence and some clout. There's a variety of campaign accounts that can be used. So sure. But they don't get to keep it. What they don't get to do anymore, Tom, and this has been true for about 30 years, they don't get to keep it and convert it for personal use. That went away in the early 90s when that started.
John, is it like this in London?
Yeah, I don't see many British politicians living in multi-million-dollar homes in the same way they do in America. Yeah. I'm still trying to figure out how career politicians become this rich in this country, Tom, but I guess we'll do some more research on that. Terry, can I get some news? I don't want to play that Elon Musk piece of sound without talking about how transparent this actually is. This all comes down to EV credits, doesn't it, Terry? Can you just walk us through how contentious this issue is becoming, both domestically and abroad as well?
Oh, I think so, yeah. It is a, it's almost the politics of the last generation, right? The tax incentives and credits and the like have always been something that have been used to kind of bootstrap transitions, and there's an awful lot of interest in that. And clearly, what Mr. Musk is up to here is trying to throw some cold water on the next generation and competitors. In that sense, it's as old as the Republic. but that has turned into a big issue, yes. But there are an awful lot of people. I think ultimately you're going to see some, because ultimately there are people who always want to be seen as on the side of the next technology, and that's a facile way to do it, frankly.
Wait, hold on a second, Terry. So are you basically saying this is in his interest because then he can basically dampen perhaps demand for some of his competitors in the electric vehicle space with subsidies? And on the flip side, it doesn't necessarily represent a mainstream view about the benefits or the detractions of the Build Back Better. Is that what you're saying?
Yeah, from the rest of this interview, I'm just going to step out and you can do it, because that was much better than what I said. Yes.
Well, hold on a second. I mean, the reason why I ask this is because heading into 2022, is the Build Back Better a rallying cry for Democrats, or is it highly controversial based on how it's been messaged and based on the inflationary push with the read that we're going to get on Friday and beyond?
The answer is yes to both. It is a rallying cry for Democrats internally. The idea of Build Back Better is huge, but at the same time, we've now pared it down from, the original talk was something like $6 trillion, and now we're talking about $1.5 to $2 trillion. So, what they want is they want something. They want to be able to say they've done something on this. But compared to where they started, it's not very much, firstly. Secondly, for not only Republicans, but crucially for independent voters, this is a real concern, because there is a newfound concern that the country is going too much in debt. There's too much being splashed around on different programs. People are feeling like the COVID threat is starting to dissipate. There's certainly no more need for direct subsidies to keep the country afloat. So they're talking to themselves internally, because it kind of is a rallying point, but it's dangerous for their broader politics.
Terry Haynes, thank you, sir. Thank you very much. Just to work through these issues, of course, two issues at play here. You get the broader tax credit, Lisa, and then you get the additional credit if the vehicle is made by union-represented workers. And I think that's where the tension's coming about here, domestically at least, between Elon Musk and this administration. Beyond that, internationally, between Europe and the United States and others too, the big push to bring manufacturing back home, to apply these credits to these cars that are made at home. And then, Lisa, how did the foreigners compete without just being based here? And we've seen that, really seen that a lot over the last few decades anyway.
And there are so many issues baked within this, smaller issues. And I think about Tesla having a head start. And when those electric vehicle credits were a new thing in the United States, they benefited disproportionately. Now they don't want their peers not only to deal with the union representation that he's had some issues with, but also with respect to also benefiting from this subsidy. And so you do wonder how much that colors his views as well.
Here's me, I thought we were going to talk about Russia, and then we end up talking about Elon Musk. Elon is very, very, very skillful at making that happen. Tesla this morning up by 3.5% in the pre-market. Your equity market, Tom, up 60 on the S&P, advancing 1.3%. There's a lift in this equity market.
John, it is Pearl Harbor, 80 years on. At dawn, we slept. The president was born 1 year after Pearl Harbor. Bob Dole, 4 years later, on the spine of Italy, was grievously injured. This is at the World War II monument, a controversial monument in Washington. I must say, when I visited the first time, it was very moving, John. It's a big day, John, for a generation.
From New York City, this is Bloomberg.
are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Two hours away from the opening bell here in New York City this morning. Good morning. On radio, on TV, up 1.3% on the S&P, advancing 1.8% on the NASDAQ, up 1.6% on a small caps. A tiny rally Monday into Tuesday. Some clear positive follow through into today. Nice. That's the equity market, into the bond market. A running commentary from Tom Keene, trying to narrate me as I go along. In the bond market, 2s, 10s and 30s. I could do a U, Tom, and cough through the whole thing. 2s, 66 basis points on a 2-year, on a 10-year right now, unchanged at 143. Talked a lot about that spread, getting flatter going into next week for that Federal Reserve decision on the Wednesday. On the Thursday, a Bank of England and ECB decision to still be had. We've talked a little bit about the ECB. Let's talk about the Bank of England. Switch up the board and finish on sterling. Brian Hilliard over at SocGen, talking about a delay of that rate hike. Not December, he's looking for February. A wait-and-see approach he's looking for from the Bank of England. Cable down to 132.46, negative about 0.1%, Tom, as we start to consider a Bank of England that will wait and wait for the Omicron data to really gauge the outlook from here on out.
To me, it's no different than oil. I mean, there's a huge polarity in the oil call as well. And, you know, just as a general weak dollar call, which has been consensus wrong for years, you just wonder where this is going.
Big week coming up next week, Wednesday and Thursday. Sterling right now, 132.46. That's the cross-asset price action. Let's get you some movers this morning. And say good morning to Romain. Morning, Romain.
Hey, good morning, John. Let's take a look at some of the big movers this morning here. You've seen a nice rebound in a lot of the big tech stocks here. A big reason why we saw that rally yesterday. A big reason why we're seeing the broader markets up, the futures contracts higher here in the pre-market. Apple up about 2% here in the pre-market after closing at a record high yesterday. Katie Huberty over at Morgan Stanley raising her price target to a street high, matching $200 a share. Nvidia, which actually fell 10% yesterday from its all-time high set back on November 29th, getting a little bit of a rebound here, up about 3% here in the pre-market. And Intel up 8% here. This apparently on the news that the company is going to list publicly shares of its Mobileye unit. Of course, this makes cameras and a lot of sensors for semi-autonomous driving vehicles here. Intel shares up 8% here in the pre-market. Flip up the board. Another big reason why you're seeing a boost here in futures contracts has to do with what we're seeing in the Omicron space here. More encouraging news on the vaccine front, primarily involving GlaxoSmithKline. A big deal with regards to its vaccine that is developing with a Canadian company, as well as its antibody treatment that is developing with Vir Biotechnology here in the U.S. Vir shares up 8% here in the pre-market. And a changing of the guard at American Airlines here. Doug Parker going to step down at the end of March here. Robert Issam going to take over. He is currently president of AAL. He's going to become CEO at the end of March, start of April next year, Tom.
Romain, what do you make of the VIX? What's your study of the VIX that you use on the close in the afternoon?
Well, we have been eyeing that 30 level, and of course we dropped down to 27 yesterday, and we're down to 23 here this morning. So you're seeing a lot of that volatility kind of tamped down, at least here in the short term. I think longer term, most of the folks that we talk to, the strategists and market makers out there, seem to suggest that, you know, we're going to be in for a bumpy ride.
Very good. We begin equity coverage today with Ed Yardeni joining in a bit. Liz Ann Saunders now with Charles Schwab. She's had the courage to be in the market and informs all of us every morning with her team with absolutely brilliant charts, sometimes Bloomberg charts out on Twitter as well. Liz Ann, buy on the dip. I guess it's once more in order. The cliche of Tina. What's the most dangerous cliche right now?
I don't know if it's a cliche, but I think the notion that the market has been so resilient throughout the year in the face of all the risks that are very well known simply suggests that you're not even peeling the first layer of the onion back. On one of these oft-posted charts on Twitter that I put is the drawdown table, looking at the index level declines, which whether it's the S&P, NASDAQ, or Russell have been somewhat limited, 5% in the case of the S&P, only 10% in the case of the other two. But the average maximum drawdown at some point this year across all stocks in the S&P is -19. It's -42 in the case of the NASDAQ. Now, that's a pretty benign way to go through a corrective phase via the process of rotation. I think we'd all prefer that over the bottom falling out all at once, but it does make for a more treacherous environment trying to trade around those rotational corrections.
Lizanne, John Farrow has in treatment a coffee table book called Drawdown Meditation, which is about the sleepiness of the market. Are we guilty right now, Lizanne Saunders, of drawdown meditation, or we've just become benumbed by this great bull market?
Well, I think there had been, and notice the emphasis on had, a tremendous amount of complacency. We were seeing speculative froth kick back in, even in some of the lower quality areas that had dominated trading in the early part of this year. But the volatility that started on Bleak Friday with the Omicron news really brought a shift in behavioral measures of sentiment. And I think that has been a factor in why the market is finding a lift, because that complacency, that speculative froth, got wrung out pretty quickly, both in attitudinal measures, survey-based data like AAII, but also positioning, whether put-call ratio or other metrics that actually look at what certain cohorts of shorter-term traders are doing. So that's not a bad setup more recently, is that quick reversal in sentiment conditions.
Lizanne, this is not a time for complacency, as you said. However, a very difficult time to hedge given the inflationary expectations, given the Fed. What's your top hedge for potential volatility at this point?
I don't know that I would call it a hedge. I know that term often gets used somewhat generically, even when applied to disciplines like diversification. I mean, I think true hedging, a lot of that might be able to be done in the VIX futures market or the options market, but there's no blanket recommendation because it depends on what it is you're trying to hedge. In terms of just trying to protect some downside, in addition to the disciplines of diversification, I think one of the strategies to consider employing, taking into consideration the increased turnover and things like tax implications, is maybe more periodic rebalancing, especially for investors that might have taken just a calendar-based rebalancing approach. They might do it at year end, they might do it at quarter end. Instead, take advantage of these swift rotations and maybe up the pace of rebalancing so you're more frequently trimming into strength, taking profits where profits are given to you, in some cases very significant profits in very condensed period of times, and dealing with that flip-flop, you're also adding into positions maybe that have had short-term underperformance. So that's probably the best strategy to approach a much more volatile period like now.
What's interesting to me, Lizanne, is that you don't talk about compositional shifts on sort of a broader scale, whether it's increasing to bonds or increasing the duration or necessarily anything that's a typical hedge. And I wonder if that's new for you or if this has always been your recommendation, basically the idea that if inflation really is the main threat, that's going to be a problem for a 60-40 portfolio. That's going to be a problem for traditional balancings.
Well, the key there in terms of things like the 60-40 portfolio is watching the correlation between bond yields and stock prices. We went for about 30 years from the mid-60s until the late 90s where that correlation was pretty persistently negative. And that's really when a 60-40 type strategy struggled a bit more. It was also an environment that had many more supply shocks. Then fast forward to the 20 years up until this year, it has been almost exclusively a positive correlation environment, in an environment where inflation was quite low and we were more subjected to demand shocks than we were supply shocks. When we first saw the eruption in inflation in the middle part of this year, that correlation dipped back into negative territory. It popped back out.
Right.
But to me, that is the key to watch heading into 2022, is if we move back into negative correlation on a sustained basis, I think that suggests we're shifting into a more secular inflationary backdrop. That doesn't mean perpetually rising inflation, doesn't necessarily mean stagflation, but to your point, Lisa, a very different environment in terms of how to add that diversification and what to do on the fixed income side of portfolios, which of course is your friend and my friend and colleague, Kathy Jones's bailiwick.
I wonder, though, at what point people take a look at the behavior of the bond market over the past couple of weeks. They say, look at the 10-year, way back down 1.43%. And that sell-off, that negative correlation just isn't going to happen because any kind of turmoil is going to lead people back into the long end of the Treasury curve. Can we make that assumption, or is it too premature?
I think it's premature. We also know that throughout the course of the past year, both when we saw that 10-year spike up to close to 175 in March, and then the equally swift retreat back down into the 115, and a lot of that was positioning and short covering. And I think you have to sort of take with a grain of salt to some degree the messaging back to the equity market in areas like that. That doesn't mean disregard what's happening in the 10-year. I think really key will be elsewhere in the credit markets, what we see happen out the risk spectrum in terms of spreads. I think that's going to be a more important tell if and when we ever get to a point where spreads are signaling a more dire message. I think that is the message for sure that equity investors want to heed. But I think you have to take that short-term positioning into consideration when looking at moves really across the Treasury curve all the way out to the long end.
Just an awesome team over at Schwab. Kathy Jones over on fixed income, Lisanne Saunders on equities. Lisanne, thank you for being with us today. Lisanne Saunders there, Charles Schwab on this equity market. Looking at one stock in particular this morning, Apple in the pre-market up by 1.9%. Katie Huberty over at JP Morgan, Tom, going to a street high 200 in line with Dan Ives. We'll catch up with Dan Ives, Tom, at 8:15 Eastern time. We'll do that in about 35 minutes.
John, I thought Apple was falling off a cliff because of China. Wasn't that like 10 days ago? World was coming to an end?
That's always the case. How many times have we doubted that name, Tom?
Yeah, and frankly, there's other names. Romaine mentioned NVIDIA here in the last 24 hours. I mean, I guess you buy the dip. I don't know. I missed it. I missed Apple 10 days ago.
The whole way up as well, Tom.
Yeah, thank you.
165 in the pre-market. Lisa, Apple, a conversation for later.
Especially because the why the shares of Apple have so much more room to rally is different. You have Morgan Stanley talking about the flight to safety benefiting Apple and in EV and in virtual reality. I do wonder if that's different, though, from what Dan Ives is talking about, which is incredible dynamism of the U.S. consumer.
Yeah, looking forward to the catch-up with Dan a little bit later. I got a tweet yesterday reminding me that Tom joined Twitter in March 2009. What was that about, Tom? The correlation between you joining Twitter and then missing the whole run-up?
That's true.
Just staying in cash the whole way up.
Yeah.
Was it Bramo on Twitter just scaring you with allocating? Your equity market up 59 on the S&P, up 1.28%. You've had enough already this morning.
He's going to go in there and take it away.
Okay, I'll take
This is Bloomberg.
With the First Word News, I'm Rishika Gupta. President Biden will warn Vladimir Putin today that Russia would face severe economic penalties for invading Ukraine. The two leaders will have a video call. A senior administration official says that the president also will tell Putin there would be benefits if he makes a commitment to diplomacy. China warns the U.S. it will pay a price for its diplomatic boycott of the Winter Olympics. The Biden administration has decided not to send any officials to February's games in Beijing. China's foreign ministry says the Olympics are not a stage for political stances or manipulation. Instagram will encourage users to take a break from time to time. The photo-sharing app owned by Facebook parent Meta Platforms will let people opt to see pop-up messages when they have spent a lot of time looking at a particular topic, suggesting they look at something else. Instagram also will remind users about alternatives to social media, such as going for a walk. Bloomberg News says it will continue to do all it can to help Staffer Hayes Fan and her family. 1 year after she was detained in China, Editor-in-Chief John Micklethwaite says 12 months of detention is a long time for anyone to endure, and that the company remains very worried about her well-being. Chinese authorities have said Fan was detained on suspicion of national security law violations and that her legitimate rights and interests are fully guaranteed. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
So do you ever commune with Conrad Hilton? Do you ever get any messages from heaven from him saying you're doing a good job protecting my name?
I haven't, but I did meet his son Baron. He was quite proud of what we had done with the company and suggested to me Conrad would have been as well.
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Number one, during pandemic, the plants were closed. Number two, the regulations and the customer behavior. They're asking more and more electronics in the car. And number three is the technological disruption, which is the electronics which we put in the car is same as what we put in our electronic appliances. And this is going to continue. We have to adjust our supply chain in line with the new normal.
Ashwani Gupta there, the COO at Nissan. From New York City this morning, good morning. Tom Keene, Lisa Abramovitz and Jonathan Ferro. Your equity market up 60, advancing 1.3%. A lift here, Tom, at 1.8% on the NASDAQ 100. Yields unchanged at the back end on 10s at 143.76. Some issuance coming at the front end a little bit later. Lisa ran you through the supply on a 3-year note a little bit later on this afternoon. 3-year notes up 3 basis points. Your 2-year up 3 to about 66 basis points now, Tom, at the front end of the yield curve.
Yeah, the 66 basis points is important. To see a breakout on 2-year yield higher would be a huge, huge deal. She's been looking at the correlations of the market and moves on today. Kriti Gupta joins us now. What chart should we look at on radio and television?
We should be looking over at China, across the ocean, look at what's going on there, because one of the big stories of 2021, Tom, has been the tech space, of course, but not just U.S. tech, global tech, and specifically what's going on with Chinese tech. The Hang Seng Index losing about 25% of its value since February. A lot of that has to do with regulatory concerns, but as a result, you are starting to see those valuations become kind of on par with the global tech average. So that's really the chart of the day today that shows perhaps that extra kind of premium that people had to pay, and we're getting exposed to regulatory risk. Maybe they're losing a little bit of that.
And there's China bulls here as well. But John, I'm going to go all John Maggie on you, 1942. And the bottom line is, I see there a set of lower highs. and lower lows. I mean, the trend is in place, right?
The trend seems to be in place, but it could turn around simply because of how volatile the sell-off has been. Now you have the fundamental reasons of China, things like copper increasing this morning because of increased imports, showing that perhaps there's more growth in China. You have the reserve requirements ratio now lower. Could that potentially mean that China is actually becoming, dare I say it, investable again?
Thank you so much. Kriti Gupta there with the trend on tech in China. And John Farrell, the trend there is the mystery of China as well.
The mystery for me, Tom, is we're talking more about the reserve requirement ratio cut this morning than we were yesterday. I find that really interesting, waking up this morning and just reading all these articles about this shift towards easing. Let's get to Enda Curran out of Hong Kong on that, Bloomberg's very own. Enda, let's start there. Are we shifting towards an easing stance in China?
Yes, I would say it's less about triple or cut, John. As you mentioned, that's kind of small beer in the world of stimulus. It frees up about $190 billion for banks to lend into the economy, but it doesn't bring down the cost of borrowing. The bigger story was the statement from the Politburo that did signal that they are coming in now to support the economy and that they may ease up on some curbs in the real estate sector. Now, let's be clear, the bigger backdrop remains that China is deadly serious about reining in risk in the financial system, but they're obviously now cognizant that perhaps they're squeezing things a little bit too tightly, especially in the real estate sector. And now we've seen this turn from the Politburo with that statement last night. And most economists today were saying it means more support for the economy is coming in the near term.
The phrase from the Politburo meeting was stability is the top priority. This is new. How big of a pivot was this?
It's a significant pivot because, again, you know, the narrative has been all about reining in credit in the broader economy. The story has been about the PBOC criticizing rampant stimulus in the Western world. They've been particularly critical of QE, for example. And China has been trying to rein in bubbles or risk or leverage in the financial system through the year. And that's why we're in the situation that we are now in the real estate sector, because they've been targeting those big property developers with the red lines, and Evergrande is in the position that it is. But as I say to you, you know, along the way, there's clearly now proven to be some spillover onto the real economy, mostly coming from the real estate side of things. Consumers have about 70% of their household value wealth locked up in property. It's about 20% of the overall economy. So it is a big drag of things. I should say, though, just to be clear, we also had some very positive news on China's economy today, which is gangbuster exports. Record shipments yet again to the rest of the world, and it shows that the manufacturing story in China, at least, is holding up very well.
Yeah, and the imports also actually outperforming or coming in hotter than people had previously expected. I do wonder, though, Enda, when you talk about support for the housing market from China, how much this hinges on Evergrande's default, the idea that there could be a huge restructuring in the housing market that they see as a potential problem they need to get ahead of.
Well, there is going to be a big restructuring. That's clear now. The company has almost said as much when it came out with that statement last week, that it would actively engage with offshore creditors on a restructuring plan. I mean, there are a couple of things going on here. On the one side, it's quite clear that the government is not going to bail out Evergrande, but neither are they going to allow it to fall over completely. So what we're going to get is something of a very muddled middle, whereby there will be a workout for Evergrande bondholders. It will be complicated. It will take a long time, but they will be at the end of the list, because in the meantime, if you bought a flat in China, you will be made whole. If you bought an investment product from Evergrande, you'll be made whole. But if you're a foreign investor, you should probably expect a haircut.
And quickly here, if James Dimon says something about China, or Raymond Dalio says something about China, how is it received in Hong Kong by the elite, by the financial elite, by the families, and by the great families, and by the government? What's the Hong Kong response to all that?
I don't know if there has been a specific Hong Kong response, Tom, but I think more broadly, as you know, when individuals at a corporation or an association make some comments, there's typically a blowback from China itself, either via the state press or via official government commentary. And we saw some of that in response to those recent comments from JP Morgan and others. I think it's less of a Hong Kong story, but I think the feeling here is that the broader corporate narrative is very much in line with what's happening with the mainland these days anyway. And that's what sets the tone for everybody.
Enda, thank you, sir. Enda Curran, out of Hong Kong. Enda, thank you very much. This line came from the White House Press Secretary Jen Psaki yesterday following a decision to boycott the Olympic Games, a diplomatic boycott of the Olympic Games, the Winter Olympics in Beijing. The Biden administration will not send any diplomatic or official representation to the Beijing 22 Winter Olympics and Paralympics Games, given the PRC's ongoing genocide and crimes against humanity in Xinjiang and other human rights abuses. Now, I think what we've got to think about more, a whole lot more, into year end and into next year. The second piece of that quote from Jen Psaki, the press secretary, ongoing genocide and crimes against humanity. Tom, is a decision to boycott this diplomatically enough? Is that consistent with how strong that statement is? Just to have a diplomatic boycott. If you believe they are the things taking place in that country right now, why would you send athletes to that country? That's a question, an important question we need to be asking.
Well, everybody's got an opinion on this other than to say the rhetoric works until it doesn't. It doesn't matter what the theme is, what the topic is, and there's a point where someone pushes back. Are we at that point now, or are we at that point as we go into the Olympics?
It also highlights how the Olympics are often the sort of linchpin of a lot of controversies. I mean, over history, it always has been in a place, or often, that generates a whole lot of controversy and questions about whether people should attend.
This one increasingly so as well. From New York City, with Ed Yardeni, the founder and chief investment strategist at Yardeni Research, coming up with equity futures positive. From New York, this is Bloomberg.
The antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We are in a boom economy, but what we're also dealing with is a variety of challenges.
We still have this inflation issue that is not going away anytime soon and is actually going to get worse before it gets better.
We've passed the peak in long-term yields, and we're probably passing the peak in the front end.
The bubble right now is not in stocks, it's in bonds.
Never underestimate corporate America.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. We welcome all of you on radio, on television as well. John, buy the dip. That's what we did.
Getting very close, Tom, to all-time highs. A rally yesterday, a rally this morning. TK up 61, advancing 1.3%.
1.3%, but I'm going to notice the NASDAQ putting out 1.8%. And, of course, lots of talk about Apple higher. Dan Ives with us, John, I believe in 15 minutes. Dan Ives, you, me, we're all focused on a 2-year yield that could speak volumes with that inflation report we see on Friday.
Looking forward to hearing from the big bull on Wall Street. Dan Ives of Wedbush looking for 200 on Apple. Katie Huberty of JP Morgan joining him this morning. She upgrades that price target. But I'm with you, Tom. On a 2-year right now, up 3 basis points. It's a small move, but we take out the highs for the year at 66 basis points as we start to have a bigger, more material conversation about higher interest rates in America.
And we're going to go serious now, folks. Please, 2 hands on the wheel if you're listening on Bloomberg Radio. Lisa Abramowitz, I want you to fold a 2-year to a high for the year into the auction dynamics we may see today.
Wow, you really set me up with something that you love so dearly, the auctions. I appreciate that. There is going to be a $54 billion auction of 3-year notes today at 1 p.m. There we did it. The interesting thing here is what is the conviction around rate hikes after the first 2, right? We know people are bringing forward the rate hiking expectations. What's the trajectory from there? That matters, Tom, especially as the Federal Reserve is going to be hiking into an economy that by most accounts will be slowing by the second half of next year.
In an American economy. But, John, this is also about EM as well, with Jerome Powell as central banker to Latin America, to the Pacific Rim.
And, Tom, you've been all over that all year. They've been tightening already. We've seen some big central bank rate hikes from around the world, including Brazil, Turkey, of course, the exception, going the other way. But to build on what Lisa said, the slowdown that people start to expect in the back end of next year, does that become more evident at the middle of 22, Tom? And if so, can they wait? So when we think about liftoff, this is what the consensus view is right now. Fully wind down bond purchasing by the end of March, Q1 done, and then have a conversation about rate hikes. That could kick off, if you're Barclays, in May, for everyone else in and around June, July time, Tom. If you start to see the data go in the direction Lisa's discussing, Tom, can they do that? And I think that's where TD and the likes of Priya Misra differ with the rest, Morgan Stanley too. They think this Federal Reserve can wait.
And it's a TD Securities with an outlier call there with Priya Misra. We'll get to that in a moment. John, on the data, I'm just going to look at the VIX. It's not in 10 big figures, but in the last couple days, we're in a solid 8 big figures to a pretty 23.90 this morning.
And Tom, you're focused on the rally in the NASDAQ. Let's pick up on that. The NASDAQ 100 up by 283, advancing 1.8%. We've talked about the front end of the yield curve up 3 or 4 basis points, approaching 67 now. 10's basically unmoved, Tom, unchanged. Some stability here, up almost a basis point to 144. And anyone whipsawed by crude, we're back into the 70s, Tom, up 175, up 2.5% to 71.25.
Right now, Ashley Oaks-Hart joins us. She is with G10 and emerging markets at TD Securities, and she has to work off the foreign exchange calls of Mark McCormick of Priya Misra with that outlier, really interesting call on yield dynamics, and place it into the trading dynamics at Toronto Dominion Bank. Ashley, very simply, how exposed is EM to sudden jolts right now?
Say it's very exposed. As Jonathan mentioned, a lot of
emerging market central banks have already done a lot of work to raise rates. We mentioned Brazil. They meet this week. We expect them to deliver another 150 basis points. That would take the overnight rate to 9.5% off the all-time low of 2%. Mexico and Chile also on the docket this month, expected to tighten. So again, these central banks are really targeting inflation only and not growth, and they're doing a lot of work to combat very high inflation prints. This morning out of Chile, we got the highest print since 2008. Currencies have done a lot of work. You can see the absolute level of some of these markets, dollar Brazil, up towards 570. So there has been a washout of positioning, and I think that the good news is that these markets are a little bit flatter from a position standpoint. That's maybe not true for Turkey, another market that we alluded to earlier, where they're actually cutting rates, coming off very high levels, which were put in place to defend the lira. And really, this price action after rate cuts is effectively the market saying that there's really a no confidence vote here for Erdogan and his policy. So that is a market where we think there still are positions trapped. Initially, the rest of EM did sort of follow along on the bad news of Turkey, particularly South Africa. And we saw that because the Turkey-Rand cross was a very popular trade earlier this year. Long Turkish lira, short South African Rand, as a way to earn the carry and really be more EM neutral in a risk-off scenario. So a lot of that position unwind has happened. Anecdotally, as Turkey continued to devolve, we saw people trying to sell the Rand as sort of a proxy hedge. I think that trade has sort of played out. So increasingly, Turkey will become less and less relevant from a price action standpoint. There's some parallels in this region as to what happened with Argentina. It was very important and topical at the beginning, and then eventually it sort of it moved off to the side and was doing its own thing.
Actually, just to build on some of the things you've said already, the big contrarian call coming out of you and the team in the last few months has been this call that the Fed will wait until early 2023, perhaps. And I just wonder how that sets you apart in the FX market as well. Is there a broad trade that you can get your hands around off the back of that call that goes against some of the hawkishness that many other banks are looking for?
FX has been really tricky in the rates context because there hasn't been a real correlation between rates and FX, and that's something that's very frustrating in our space. Does it differentiate us? Potentially. I think for me, into year end, what's particularly concerning are the changing liquidity dynamics, and to the extent that it's getting much worse. We're seeing reduced liquidity in U.S. fixed income. You can see we've had really aggressive price action there. Certainly Friday was very interesting on the back of sort of a weaker employment number. The market tried to rally, then sold off after ISM, only to rally into the end of the session. And then obviously we had a big day yesterday. So we're seeing reduced liquidity conditions there. That's moving into G10 FX forwards, and certainly emerging markets. And that's not a situation that will likely improve into year end. If anything, it will get worse. So that's certainly something that we're watching.
Ashley, this is a fascinating point, especially because the logical consequence should be potentially a weaker dollar if the Federal Reserve does not have to hike rates as quickly next year. Are you saying that's not necessarily how it's going to play out based on the trajectory of a weakening U.S. economy and the bleed through globally?
It doesn't have to play out that way, no. I mean, in extreme stress, we have seen the dollar act as a risk asset. So, the price action the day after Thanksgiving, certainly you saw the dollar move higher on risk off. But again, it's pretty rudderless here in a rate environment. Could you see, certain currency pairs outperform if we have central banks being more aggressive? What does the Bank of England do next week? I think the market's 30% priced for a 15 basis point hike. If they were to go first, you could certainly see a bid in sterling. And we have hit some pretty big levels against the commodity currencies. Certainly Aussie touched that 0.70 level yesterday morning. Very important. It bounced off that pretty hard. The RBA a little bit hawkish this morning, and we're seeing Aussie move higher again. So it's just there's no clear narrative here. At some point, could the U.S. be a low yielder, and then we get weak dollar price action on that? Potentially, but I don't think we're there yet.
You seem more exasperated with it than I do, Ashley, and that's something. It's great to catch up with you. We appreciate it. As always, Ashley, good to hear from you again. Ashley Oakes-Hart there.
Thank you for having me.
TD, thank you very much. It's just been difficult to read, Lisa. You take euro dollar and just go to the start of the year. The start of the year was the high of the year for euro dollar. And you remember all the calls coming through. We'll get more. Euro's going stronger. And it's been weaker ever since. We've come all the way down from January 6th at 123 to 112.57 to the back end of the year.
And there's no consistent thread. Perhaps you could say for the euro it's because you're pushing back the actual recovery. But really, you have not seen consistency. Some people, Russ Kostrich of BlackRock, coming out and saying that the dollar is the best hedge against downside in the equity markets. Everyone has a different rationale for why they see stronger or weaker dollar, and it does not seem consistent right now.
Tom, you've lived it time and time again. How many times have we got that dollar call wrong coming into a new year?
Well, it's like the yield call we've had for 15 years. What I loved about Ashley there is she has a trading history. And the way you lose money, John, is not big, broad, 60,000 feet, blah, blah, blah. You lose money when the bid walks away. And you're like, oh. And she's lived that. So she's looking, you know, the tentativeness I heard from her on where we're going is the day-to-day battle of bid and ask.
It's been very, very difficult, whipsawed over the last few months, particularly if you're exposed to the Turkish lira. Let me turn to the FX market. Euro dollar looks a little something like this in G10. In the FX market, euro dollar 112.58. In the equity market, futures positive 59. On the S&P, we advanced 1.29%. There's a lift in this equity market, a lift in the commodity market, crude up 2.73%, call it 2.78 to 71.42. Lisa, it's risk on this Tuesday morning as you get back to work.
It's risk on, and yet the 10-year yield still at 1.45%, despite the fact that people are firmly pricing in 2 rate hikes next year. John, that to me is notable.
2 rate hikes, call it 3, maybe even more. Barclays talking about May. We had Bank of America over the weekend, Tom, threatening an earlier move, maybe in March. The rate hike call has come together off the back of a conversation at the Fed about winding down QE. I do wonder, Tom, how much the chairman pushes back against that next week. He wants to build in flexibility, not a one-way trade.
He wants to build in optionality, and he's going to say we need to wait for the data. That's what let's say we get 7% inflation.
Wait, can he do that, though? Honestly, can he come out and say we're waiting for the data when the world is expecting him to accelerate the taper? I don't think so.
Oh, I think, can he make the decision to accelerate the taper and then do what Tom says, Lisa? Can he do that?
Conditional. I don't know. I mean, honestly, they're building an optionality so they can hike rates. That is the reason why. I mean, how can you divorce those two?
Belief. If they want to, not necessarily because they're going to.
Right.
Do you think it's flexibility or a one-way path towards a rate hike? I guess is the decision you've got to make, Lisa.
Chairman's based.
There's always flexibility, but
that's
the
helpful,
signal,
Tom.
You know.
You want to explain that to Chairman Powell next week, TK?
Yeah, I will.
What does based mean?
McKee can stand up and ask the question.
From New York, this is Bloomberg.
That was based.
With the First Word News, I'm Rishka Gupta. The US and Europe are considering tough financial sanctions against Russia if Vladimir Putin invades Ukraine. Bloomberg's learned that Russia's largest banks will be targeted, along with the country's ability to convert rubles into dollars and other currencies. President Biden may spell out the sanctions today when he and Putin have a video call. Russia has denied it plans to attack Ukraine. A new coronavirus vaccine has shown 71% effectiveness against multiple variants of the disease. The shot was developed by GlaxoSmithKline and Canada's Medicago. According to trial results published today, no vaccinated participants developed severe disease and no serious side effects were reported. The shot will also be tested against the Omicron variant. The UK is moving forward to increase trade with individual states, and it's ready to resume talks with Washington on a broader federal deal. British Trade Minister tells Bloomberg discussions are set with California, Georgia, Tennessee, South Carolina, and Oklahoma. She meets with U.S. Commerce Secretary Gina Raimondo this week. And Intel plans to take its Mobileye self-driving car unit public by the middle of next year. The chipmaker will remain the majority owner after the shares are listed. Intel bought Mobileye in 2017 for about $15 billion. Since then, the unit has consistently grown faster than its parent. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also, we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's the semiconductor names who are fueling some of the technology growth within consumer electronics, and that has been held back this year because of the supply chain constraints. We still see them having very strong pricing power going into not just middle of next year, but beyond that as well. So people talking about that cycle ending, we think it can go longer.
Louise Dudley there, the portfolio manager at Federated Hermes. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro, live on TV and radio. Your equity market up 60, advancing 1.3% on the S&P 500. The S&P advancing from yesterday's move, some positive follow-through on the NASDAQ too. The NASDAQ 100 up 283 at 1.79%. Yields higher on the back end and the front end now. The back end up by a couple of basis points to 145, let's call it 144.95. Apple one to watch in the pre-market. I think I said Katie Huberty of JP Morgan earlier. I apologize for that, Katie. Katie Huberty of Morgan Stanley raises her price target to 200, a street high in line with Dan Ives, who we'll catch up with in just a moment. 168.79 in the pre-market, up 2%. Here's the quote from Katie, Tom. Despite a consistent and material revenue contribution from new products and services over time, Apple shares don't seem to bake in the impact from upcoming new product launches. That is the view from Morgan Stanley. This stock, Tom, year to date, is up by almost 25%.
Well, there it is on Apple, and what we need to do is have the interview of the day, John, with Daniel Ives. He's Equity Research Managing Director at Wedbush. He has been the Apple bull, maybe joined by Mr. Huberty. I've got to ask the obvious question. In the nuclear war known as a higher price target on Apple, do you have to respond to Ms. Huberty and go up by $1 or $2?
Yeah, I'll go to 201 right now.
202.
That's the banner.
But what I think Katie is talking about is similar to our checks. That if you just look at services in the iPhone, I think this is a $3 trillion market cap into next year. But then you look at Apple Glass, which we think gets released middle of next year, the AR/VR, that could add another $20 a share to the stock.
What does management have to do to signal cash flow persistency to move the stock along the path to your 3.6 trillion, or dare I say a 4 trillion valuation? What is the action they have to do quarter to quarter?
Well, quarter to quarter, of course, the iPhone cycle in terms of what we're seeing, even though supply chain continues to be an issue, they need to execute there. I think right now they're on course for their strongest holiday quarter ever. But when you get into, from a cash strategy, that buyback, they're going to up that probably in the next 6 months. And they're going to continue to invest in the new products. We think that's Apple Glass, which comes out middle of next year, and then ultimately the Apple Car by 2025. And you start to put that all together, this is a $3 trillion market cap into next year, in our belief, as they execute. And then this is one, I view it as a renaissance of growth happening in Cupertino.
Dan, this is what I want to build on. This is something Katie also said. We believe this will change as Apple approaches the launch of an AR/VR product over the next year. This is not just blue sky thinking, Dan. I just want you to walk me through what they're going to be launching here, what this new product lineup really looks like in the next couple of years, and when we actually get some money.
Yeah, they've been working on this for about 4 years in the labs in Apple Park. Getting released over the last year or two. I think now it's ready for prime time. Why it's important from an AR, VR, it's about monetization. You're talking about 1.7 billion iOS devices worldwide. You start to penetrate that, just like AirPods is going to sell about 100 million units this year. That could be 4 or 5% of revenues as you look out into the next 2 to 3 years. And I also think, just when we talk about metaverse, this is really going to be the drum roll to what really opens up the metaverse when Apple Glass comes out. We believe at WWDC middle of 2022.
Dan, how much is your call based on some of these new products, based on demand, and how much is it a call that the Haven trade in stocks will remain in place and that technology stocks more broadly will benefit from that?
Yeah, 200, we don't value any of the new products in there, from Apple Glass to Apple Car. I view that all as incremental. To me, it's what's going on in terms of this super cycle that continues to play out, even though the supply chain is taking about 10 million units. You put that with the services. We think services worth 1.5 trillion. And no doubt, there's going to be worries going into next year in the tech trade. I still believe tech stocks, in terms of the stock pickers market, Apple being one of them, up another 15 to 20% overall. But I think Apple's one that it continues to be underestimated in terms of what's going on here in Cupertino.
That's actually a reason, perhaps, that you could see rivaling Katie Huberty and raising it to $201 for a price target. Is that what you're saying? That basically, if you start to factor in some of the products that she's looking at, we get a lot higher in terms of multiples. Is that right?
Well, our bull case is 225.
Oh, there you go.
So
but come on, this morning, we got to stop the show, Dan Ives. Lisa Abramowitz is dead on. You got a top tick Katie right now on Bloomberg surveillance. That's what your public demands.
This is a game show?
Okay, if you give me 5 minutes, I could write the note, and then we could do that.
Okay,
but it's, yeah, no, but what Lisa's talking about is important, because when you look at Apple, it's a forest with the trees. You start to look at the new products, the monetization. It's unique to what Cook is doing over there. You know, not just in the U.S., but you look globally, what they've been able to do from a capacity perspective. I think this is just the next step of the Apple growth story.
Dan, I look at where we are, and here's what everybody's saying. Those that really respect your work and all of the sell side, and then particularly the bull sell side. 10 days ago or whatever, the world was ending. iPhone sales weren't going to happen. China that. How do you recommend normal people, not expert like you, adapt and adjust to rumors out of the Pacific Rim? OMG, Apple's dead.
Yeah, well, reading Asia's supply chain, especially in the midst of a shortage, is very difficult. I think it's one that you have to continue to just look at the numbers, you stress test. Right now, 25% of iPhone users haven't upgraded their phone in 3.5 years. So that's 250 million upgrades that are going to be coming over the next 12 to 18 months. And you start to do the sum of the parts. You know, even you could have some gyrations, but this is a stock you continue to buy on dips along with Microsoft and others. And I think it's one where that creates the opportunities when you have noise. And even though there's froth in the market, you look at Apple, it's a rock of Gibraltar, and you know, what's sometimes a turbulent market.
Back to record highs for all the doubts, the concerns about supply issues, concerns about demand issues through the holiday season. Back to all-time highs, up 24.59%. I got some sympathy with you, Dan. The compliance issues, I understand. You don't want to get the tap on the shoulder. Dan Ives is at 200. At 200 is price. The $1 matters. Dan Ives of Wedbush. Dan, Good to catch up, buddy. It's good to see you.
Thank you,
sir. Up 60 on the S&P, advancing 1.3% on the Nasdaq 100, up 281. We got a lift in this market, Lisa, up 1.8%.
And I got to say, it's a lift without necessarily a real sell-off in the long bond. I find that fascinating, given the fact that we're talking about rate hikes, that we're talking about a sigh of relief from Omicron, and we're talking about more stimulus from China. Somehow that is not lifting the prospects for longer-term yields. I find that notable.
The curve is flatter. The sell-off is at the front end. Yields are higher on twos by 4 basis points now. Tom Keene, 67 basis points on a 2-year note.
I mean, I'm worried about getting into Apple or not. 20-year track record, this after the March collapse of 2001. They've done 36% per year.
What a run-up it's been. From New York, Ed Yardeni up next, the founder and chief investment strategist at Yardeni Research. Looking forward to that. From New York, heard on radio, seen on TV for our audience worldwide. This is Bloomberg Surveillance.
So do you ever commune with Conrad Hilton? Do you ever get any messages from heaven from him saying you're doing a good job protecting my name?
I haven't, but I did meet his son, Barron. He was quite proud of what we had done with the company and suggested to me Conrad would have been as well.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
For many US-based investors, there are basically 2 days left this year. There is Friday, the CPI report in America. There is next Wednesday, a Federal Reserve decision. And then, for many of us, it's year over. Up 61 on the S&P, advancing by 1.33% on the Nasdaq 100. Up 291, advancing 1.8%. There are some moves in this bond market I want to discuss. 145 on 10s. Your high of the year, your intraday high of the year on a 10-year yield was 177. It was the end of March 30th to be precise. Your high of the year on the 2-year is right now, up 4 basis points, 67, and that's contributing to the flattening we've seen on this yield curve. Tom, as you pointed out, and we've pointed out repeatedly over the last week or so, your yield curve, the distance between 2s and 10s, is back to where it was at the end of last year, 78, call it 79 basis points.
To 4 digits, I want your 2-year yield, John, 0.6712. I don't know, is 0.70, is that a big deal?
I guess, Tom, but we've got to have a bigger conversation, haven't we? Is that it? Is that it? PGIM's Robert Tipp said we've topped out on both 10s and on the front end too.
Raging debate here.
That's very contrarian, Tom. And this market, there are people out there who believe we stall out at 175. There are others who think the Fed funds rate, Tom, has to go much higher.
I've got 8 ways to go here, John. We did this earlier with Liz Ann Saunders of Charles Schwab, and we're now thrilled to extend the conversation to give you global Wall Street perspective with Edward Yardeni. He is founder and chief investment strategist at Yardeni Research. Long ago, high above Cayuga's waters, he knew double-digit inflation and then on to parchment at Yale University. Ed, I thought, there we go. Thank you. Good morning, Cornell on radio. Ed, I want to go to the Krugman essay last week where he destroyed monetarism and said simply, it was a theory then, it's not now. What should we do with our collective memory of the ghosts of the 70s, the theories of Milton Friedman?
Well, I think he was right up until the pandemic. We did see a tremendous amount of quantitative easing, 0 interest rates. Central banks provided a tremendous amount of liquidity. And yet there were some very powerful forces that kept inflation down. Disinflation was the law of the land for many, many years following the great inflation of the 1970s. It was things like globalization and technological innovation, aging demography, and too much debt that all were fundamentally disinflationary. But the pandemic changed all that because it really put monetarism on steroids and speed in the form of modern monetary theory. We just had this unprecedented increase in government debt, deficits, and all of that was to a large extent financed by the central banks.
Help us with the distance here from Dartmouth College and David Blanchflower, Hanover, New Hampshire, and the University of Cambridge and Dr. El-Arian. They are polar opposites on the inflation guess. Where do you stand on that?
Well, I think inflation is persistent. Obviously, the word transitory is no longer allowed in our conversation, according to Jay Powell, so persistent. I think it's going to be 4 to 5% for the consumption deflator until the middle of next year. And then I think it does ease back down to 3 to 4%. I don't think it's going to go back to 2% anytime soon. And I will not be surprised if the Fed deals with that by raising the Fed funds rate by maybe 2, maybe 3 times. But I think they might also seriously consider raising the inflation target, moving the goal from 2% to 3%.
Ed, so a lot of people are looking at a Federal Reserve that is still responsive to market turmoil, that basically if they do signal that they're going to raise rates next year and there is some sort of tantrum, they'll step in and ease some of the conditions. How much is that anachronism at this point, given that there's a very different paradigm?
I think it is. You're absolutely right. It's a different paradigm. And we've had 4 taper tantrums since 2013. We had one in May 2013, and then we had another one in early 2016, one in right before Christmas on 2018, and then this one. This one is a work in progress. It's not clear just how it's going to play out. But I think that the big difference is this time around, the Fed can't give the market what it wants, which would be, okay, back off, don't taper so much. Simply because the inflation problem is real, and the Fed has made it very clear that they are now concerned about it. So it's going to be pretty hard for them to back off.
Although I do notice in the data, there's been a real shift over the past few weeks, that people are bringing down their longer-term expectations once again for inflation. It seems as if people are convinced that a Federal Reserve hiking rates in the near term will allow growth to revert to something similar to what we've seen in the past, albeit possibly even lower based on the demographics you're talking about. Is that a reality in your perspective? Does this give them leeway to hike a couple times, let it go, and actually have a smooth exit?
I hope so. I think that's the consensus view. Maybe it's wishful thinking. Maybe, you know, the pessimism about the near term is being offset by the perception that the pain now will lead to gain later. Look, first and foremost, I don't think this is going to wind up to be like the 1970s. There's some aspects of that going on right now, like a wage price spiral, which is of concern. And we're already seeing some cost of living adjustments being put into contracts. But I'm a big believer that productivity is making a huge comeback. And the reason for that is one of the huge differences between now and the 70s is there's no growth in the labor force, and that's related to demography. And companies are just going to have to increase productivity to offset the fact that the labor shortages are not temporary, they're chronic.
Ed Yardeni, I want to go to your book, and I want to say it is a triumph to Meghan Desai of the London School of Economics, where Ed Yardeni, folks, writes in praise of profits, and you begin with the great David Ricardo, who changed how we think. And this underestimation of profits. Is the profits now for technology different than the profits of December of 2000?
Absolutely. I mean, in 1999 and 2000, a lot of the profits in technology were based on dot-com companies who had really no serious business plan, ordering technology and paying for it with credit. The big situation back then was that you had telecom companies seller financing their customers. So those profits were kind of phony. And it was a period where there was a lot of manipulation of profits. This time around, these are very real profits. They're based on very real businesses. And I think technology is the wave of the future. It always is, but it's more so than ever.
How do you respond to the cry of 15 years that the profits are all going to a few?
Well, there is this kind of Marxist view out there that if a company is profitable, it must be exploiting somebody, and it's probably exploiting workers, and it may be exploiting consumers by not giving them the very best. But I make a distinction between two kinds of capitalism in my book, and that's entrepreneurial capitalism and crony capitalism. I actually am in the same camp as progressive socialists when I say that I'm against crony capitalism. Crony capitalism isn't capitalism. It's all about using the political system to game the system. I'm an entrepreneur myself, and I can't afford lobbyists, so I think that's really the definite distinction between an entrepreneur and a crony is whether you can afford lobbyists or not. I can't, and I've got to compete. I've got to give customers the very best. So in my book, I also argue that Adam Smith did a terrible job of marketing capitalism by telling us that it's all about selfishness. It's not selfishness. It's insecurity. I'm going to go out of business if I don't give my customers the very best of what I have.
I'm sure that that's a harder sell, that capitalism, go for it because it's based on insecurity. I do wonder, though, Ed, just going into the realm of trading, going into the realm of how you position in such a tenuous period, given that you do feel overall optimistic about productivity, but a little bit concerned about the Fed and how that all shakes out. Have we already priced in the dynamism in technology, the productivity gains that you're expecting, or do you think that that will fuel further gains in the headline indexes next year?
Well, look, I think the best is yet to come for us in terms of prosperity, in terms of standard of living. I think technology is going to solve a lot of our problems. It is solving a lot of our problems. Yeah, I mean, we're not going to get double-digit increases in the stock market anytime soon. Earnings peaked on a year-over-year basis in the second quarter, and that doesn't mean they go down. They just grow at a slower pace. So I'm predicting that we go from 4,800 by year end. So we're getting close, but they're single digits consistent with single digit increases in earnings.
Ed, looking forward to giving the book a read. It's on my desk. Thanks for being with us this morning, buddy. Appreciate it. Ed Yardeni of Yardeni Research and author of The Praise of Profit. Thank you, sir. Your equity market up 62, advancing 1.35% on the Nasdaq 100, up by 1.9%. A really interesting market. Get to the bond market, 2s, 10s, and 30s. And look at 2s, up 4 basis points on 2s right now, up to 67 basis points this morning, Tom. And just a gap lower on euro dollar. If you get to an intraday shape of the chart of euro dollar right now, just a gap lower to 112.31, Tom.
And I had forgotten, John, did we get like over the last 20 days to a 111 handle?
We did. November 24, 111.86.
Yeah.
So just a number of weeks ago. Getting closer to it, Tom, as we approach a really key week for central bank decisions. Wednesday, next Wednesday, into next Thursday.
What do the tots do? I mean,
what do they, in terms of, will they play the game?
Will they play? I mean, they had snow last week. And this
now they've got a COVID outbreak, and because of the snow last week, Tom, they're a game short. They've got a lot of games to play. The Christmas period's very busy for Premier League football, so they wouldn't want to postpone the game. But if they've got a lot of characters missing, they might have to do that.
And
because
we don't
of
know
that
who
COVID
they are.
outbreak.
We don't know if it's like
I haven't
Mr.
got that level of granularity right now, Tom. I haven't got that detail.
You're like hardwired in. I thought you.
No, well, I've been doing a show for the last couple of hours, so I'll try and find out afterwards for you, Tom. Looking forward to catching up with Bank of America and Jill Carey-Hall, US equity strategist of Bank of America. Well, you've been doing a show too, Lee. So you suggesting that Tom hasn't been doing this show with us this morning?
I thought he was asking, what do the tots do with the 111 euro dollar? And I was thinking, where's this going to go?
Is he talking about the transfer season and euro sterling?
Exactly.
And going on a spending spree on the continent? That would be smart, Lisa. I'm just not sure that's where we were going just then. Up 62 on the S&P, advancing 1.3%. This is Bloomberg.
With the First One News, I'm Rishika Gupta. President Biden will warn Vladimir Putin today that Russia would face severe economic penalties for invading Ukraine. The two leaders will have a video call. A senior administration official says that the president also will tell Putin there would be benefits if he makes a commitment to diplomacy. China warns the U.S. it will pay a price for its diplomatic boycott of the Winter Olympics. The Biden administration has decided not to send any officials to February's games in Beijing. China's foreign ministry says the Olympics are not a stage for political stances or manipulation. Instagram will encourage users to take a break from time to time. The photo-sharing app owned by Facebook parent Meta Platforms will let people opt to see pop-up messages when they have spent a lot of time looking at a particular topic, suggesting they look at something else. Instagram also will remind users about alternatives to social media, such as going for a walk. A leadership change at American Airlines. CEO Doug Parker is stepping down at the end of March after more than 8 years in the job. He'll be succeeded by American's President Robert Isom. Parker will remain chairman. Bloomberg News says it will continue to do all it can to help Starfa Hayes-Fan and her family 1 year after she was detained in China. Editor-in-Chief John Micklethwaite says 12 months of detention is a long time for anyone to endure, and that the company remains very worried about her well-being. Chinese authorities have said Fan was detained on suspicion of national security law violations and that her legitimate rights and interests are fully guaranteed. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
We've been seeing input costs in one way causing a lot of disruptions in the industry and across several different categories. At the same time that you see a lot of costs going up in labor costs, transportation costs. In our case, we manage this very closely, and we do have the tools to work with higher inflation.
Managing the message within a pandemic, and of course an important message at AB InBev, Mikhail Dukaris, their Chief Executive Officer. This is a wonderful time for Lisa Abramo tonight to speak to Mr. Ritholtz about when Peter Lynch, one of the great moments of my tenure, has been the day that John Templeton died. And I turned to Emily Hosgotzel and I said, get me Abby Joseph Cohen. Everybody rallied. We did a spectacular show, including with Dr. Templeton, the son of Sir John. And we, of course, asked for Peter Lynch. There is a terrific story today on the Bloomberg with an update on the vice chairman of Fidelity. And Barry Ritholtz is here to join us now on what is unique about the man who founded A Certain Way to Invest. Barry, to me, Peter Lynch was walking around the streets of Boston with value line copies in his hand, making sector bets. Boy, that worked for a while.
You know, I've been watching the Peter Jackson documentary on the Beatles, and they had a very short tenure, but they were the greatest of all time. And Peter Lynch, very parallel. How long did he run Magellan for? It was barely a decade. Very, very few people have ever put together a track record like his, especially in terms of that size. It's one thing to do it with a few $1 million, but tens of billions of dollars and consistently beating the benchmark. It's astounding.
And what was so important here, as he mentions to Tom Maroney and Joe Shortsleeve, is the idea that he passed that heritage on to Bettina Dalton and particularly to Will Danoff and Joel Tillinghast, that, you know, you don't just have to be passive. There's a way to win. Barry, how do you win in 2021 active?
So first, and I've interviewed both of those gentlemen you mentioned. I've interviewed Peter Lynch at the MIT Sloan Conference, and Will Danoff was a guest on Masters in Business. And it's very, very clear that they have a very specific methodology. They have a process that they use. They continually refine that process. It's very empirically driven. Lots of people try to do that, but very few have succeeded. Lynch gives a lot of credit to the infrastructure and the support he got at Fidelity. And so in some cases, size becomes a giant advantage when you could throw a ton of resources and the best and the brightest at your process and at your fund.
Barry, has the game changed, though? And this is what a lot of people have been saying, that with the increasing influence of central banks and some of the extreme actions that they have taken, the game has shifted and you are not likely to get ahead of anyone trying to predict these market moves. You just have to bet with or against an index, and that's it.
Well, don't send me back to my college philosophy classes to start quoting Heraclitus. The game is always changing. It's never the same. If you're not constantly refining, iterating, adopting, you will be left behind. And that's some of the things that Lynch did and people who followed him. Will Danoff, people thought he was a dinosaur. The guy has consistently been on the cutting edge of tech and new ideas when younger people missed it. Here's a guy who people looked at as saying, the track record, how can this guy possibly compete? Yeah. It's a young person's game. The secret is you must continually iterate. You must continually adapt. The market is always changing. Sure. All right, so now it's the Fed. Before it was fiscal policy. Before it was money flow. It's never the same. You must avoid becoming an expert in the way the world used to be. That doesn't work.
Barry, I do wonder when clients call you and they say, should we just be all in indexes and just get the composition right and we'll be better off? And you say, focus on the fees, or do you say, actually, there are some active managers that have consistently outperformed? How do you position the advice that you give based on this passive-active dynamic?
And I'm going to just point to what Peter Lynch said today. You can't be all in on index to the exclusion of everything else. So a good concept is have the core of your portfolio be a passive index where you're guaranteeing yourself you're going to get pretty close to market results. That's the base. If you want to build around that and say, I want to have a little more technology, I want to try and identify some early stage companies or some emerging managers or some successful managers, you can hang those ornaments on the tree, but passive is the key middle part of any decent portfolio, whether it's 50%, 60%. In the world of advisory services, that's a great way to begin.
Barry, the history of this off of George Putnam is wide diversification. You and I remember 100, 200, even 300 stocks in a portfolio. And not Peter Lynch directly, but Ned Johnson and the team there came up with a concept off of Sequoia, I'll say, called the Fidelity 50 Fund. It's been merged in 2015 and that. Is it better to hold in a mutual fund, in an ETF, a lesser amount of issues, or do you believe in what Phil Correa believed in at Pioneer?
So two parts to that question. First, academic research has shown us that the vast majority of returns and excess returns come from a tiny percentage of stocks. It's like 4% in the US and 6% globally. So if you're going to be an investor, an active investor, if you're going to be a stock picker, then you should have the courage of your convictions and have a concentrated portfolio. If you want to talk whether it should be 50 stocks or 20 stocks or 75 stocks, it's almost irrelevant, but it shouldn't be 1,000 or 2,000 stocks. That is especially helpful if you're marrying it to the S&P 500 or the Vanguard Total Market. Hey, if you own 3,000 stocks in the Vanguard Total Market Index, then you can have a chunk of your portfolio, 5, 10, 15%, in a concentrated 30 or 20 stock index or 30 stock actively managed set of holdings. But the combination is what makes it work so well together.
Folks, what you just heard there from Mr. Ritholtz is a combined wisdom of hundreds and hundreds of years of the Ritholtz clan that goes back. Barry Ritholtz, thank you so much. Greatly appreciate this comment on Mr. Lynch. I'll get that story out on Twitter. Lisa, I can't say enough what Barry just said there about the academic research, much of it out of Vanderbilt and UMass Amherst, on too much diversification. Peter Lynch used the phrase diversification.
If you have conviction, why not just go with it and concentrate your bets? And we have seen that certainly increasingly in equity markets and certainly among certain hedge funds. Taking a step back, though, when you talk about the game changing, the key aspect here is a lower benchmark yield. When you have a lower yield point, how much more do fees matter? How much does it crimp the ability to be effectively active? And that, I think, has been a challenge on an ongoing basis.
Huge challenge. There's no question about it. The diminution of the rate structure over 15 years has made the active cost ever more painful. This has been interesting. Thank you to Barry Reynolds. Thanks to our team for bringing up that great Tom Maroney, Joe Short Sleeve story from Bloomberg. We continue an active day here. Futures up 59. This is Bloomberg.
Years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops, tanks, guns, UAVs. Clearly, neither side are taking any chances.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the Q3 was the quarter that was most affected.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. What happened to the sell-off from New York City for our audience worldwide? Good morning, good morning. Here's the bounce from yesterday into Tuesday, up 58 on the S&P, advancing more than 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, finding opportunities in the volatility.
This time round, it's going to be volatility.
2022 is going to be macro volatility.
That volatility of volatility.
It's going to be Fed hikes. It's going to be virus. It's going to be those kind of things.
The Fed is taking away the punch bowl, possibly.
You're going to see the Fed have to move a little more aggressively.
You're worried about all of this.
Which is going to create all sorts of interesting opportunities.
The worried market's a great time to be an investor.
Pretty substantial walls of worry.
The volatility is here to stay.
And that means fundamentally a lot of pockets of fixed income credit investments are going to be good places to be.
It might be a little rough in the fixed income markets.
You're going to be wanting to be long S&P.
The market is certainly where I want to be.
Volatility is going to be large and more substantial.
And that's just the world we're living in today.
Joining us now on this discussion, I'm pleased to say, is PGIM's Greg Peters, Patrick Palfrey of Credit Suisse, and very shortly, a little bit later in the program, we'll catch up with Jill Carey-Hall of Bank of America. Greg, I want to start with this market. For all the talk of all the things to get worried, concerned about, I've done this a few times this week already. We're a couple of percentage points from all-time highs on the S&P 500, Greg. What do you make of this?
Well, I mean, we're kind of looking through everything at this point in time, but just because we're here now doesn't mean we're there tomorrow. And I think that is really the message. And so I completely agree with the prologue of this program, which is volatility, I think, is on the rise. There's so much uncertainty. Valuations are much more stretched. You have central banks really kind of looking the other way, it seems to me. And I think we're in for a much more volatile ride going forward. But at the same time, I do agree it's a great opportunity going forward.
Well, let's talk about where those opportunities are. Patrick, where are those opportunities right now for you?
Well, for us, we see the biggest opportunities in a few cyclical areas. Energy, as oil continues to rebound, and we think there's structural reasons why oil should be moving higher here. And with that, I think materials and industrials benefit. And I think those investors with longer-term time horizons can really take a look at technology. I think there's concerns around the valuations, but when we take a look at the expected GDP growth out a couple years, those companies are really driving their own success. They're going to continue to deliver on the top line. And we don't view the valuations as being concerning when you look out a couple years. So depending on your time horizons, I think tech works really well here.
Well, let's talk about that, because if you have a longer time horizon, you might get that low growth profile again. But with that, you might get higher rates. Isn't that the key piece of this, Patrick? If you get low growth and low rates, then growth equities works, big tech. Does it work if you get higher rates?
I think it becomes more difficult when you get higher rates. And I think when we're talking higher rates, we're talking a 10-year, well above 2.5. I think the question that investors need to be asking themselves is, can we, and we believe we can be, in an environment where we have incrementally higher inflation, but rates remain contained? In that environment, corporations have a tremendous opportunity to grow sales, to grow the bottom line, but not get penalized from a discount rate. So you get the valuations to work and you get the profits to work. And that is a tremendous scenario. That's what we're in right now. And we think that scenario actually persists.
That's why I'm looking forward to catching up with Jill Carey-Hall of Bank of America, because their call is as follows. What happens to the Tina argument if cash yields rival the S&P 500's 1.3% dividend yield, and if the 10-year yield hits 2% by year-end next year? Greg Peters, when it comes to the fixed income side of this call, you do think rates will be contained. You and the team, PGIM, have made the point that you think the high and the 10-year yield is behind us. It's not in front of us. Why is that, Greg?
Well, so if you just look back, right, in March when it hit the high of 170, 175 on the 10-year, you were at peak growth, peak inflation, peak stimulus, both from a fiscal and monetary standpoint, and that's all you got out of the bond market. So I struggle with why there's an expectation with all that behind us that rates are all of a sudden going to accelerate higher. It's an argument I just don't really quite understand.
Is that not in the logical sequencing that the central bank is offering us right now, Greg? I think that's where you've got to have the disagreement. Some people believe that we're about to pare back QE quicker, and that automatically sets us up for a rate hike. Others say it's about building in flexibility. What gives you the confidence it's about the latter and not the former? It's not about just a direct path towards a series of rate hikes through next year and beyond, Greg.
Well, so look at what the bond market has told you over the past month or so, right? So as the Fed and other central banks have abandoned kind of their slower approach, the front end has moved and the back end has rallied, right? So what the bond market is telling you is that the economy can't necessarily handle higher rates, and that's why the curve has flattened, and as you mentioned before, it's back to where it started a year ago. So I think the bond market is quite clear in telling the equity market, central bankers, that if you hike too much, if you actually hike what's in the market currently, you are slowing down the economy in such a way that you're getting closer to a recession.
So, Greg, I want to get a call on the front end and then go across the Patrick on what it would mean for equities. 2-year yields this morning are up 5 basis points to 68. How contained do you think a potential move at the front end is, Greg, with everything you've told us? What's the limits of that move?
I think we're kind of close to the limit already. So, the move has been quite dramatic thus far, a big change over the past 6 months. I struggle with a lot more movement in the front end, honestly. But if I'm wrong around that, then I'm much, much more bullish on the intermediate and back end. So to me, the most important metric to evaluate in the markets today, all markets, is the path of the 2-year. If the 2-year continues to move to higher levels, I actually think that rings the death knell for risk assets going forward.
And Patrick, is that what you're focused on as well? What happens at the front end of this yield curve?
Well, for us, we're taking a view of the long end, and I think what it comes down to is what the long end signals, and that's demand for capital. And we talk about why interest rates are as low as they are. I think if you look out a couple years, we have a structurally lower GDP environment going forward. Certainly, right now we're recovering on an economic bounce, but that's expected to really begin to slow over the next 1 to 2 years. So you have to ask yourself, what is the terminal level of GDP? And it's slower than where we were before for demographic reasons. So when you take that view, it's not surprising that the 10-year isn't really higher here. So I think cyclicals work as a trade coming out of the economic recovery in this bounce. But I think longer-term technology and those companies that are really driving down success are absolutely where you want to be.
Just get to the index level quickly, Patrick. Where does that leave multiples? This was the call from Morgan Stanley over the weekend. A new COVID variant started the ruckus for markets, but we view that as secondary to the real culprit, the Fed's more aggressive response to the on-fire data. It's been hot. Lower valuations is our call for 22. Tapering is tightening. What's your view on multiples at the index level, Patrick, into next year?
Well, I think in a weird way, I think we actually agree with Morgan Stanley, but I think our view is a little bit different. We see multiples as lower incrementally because profits are continuing to grow incredibly strongly. So the E is growing faster than the P, therefore multiples fall. Do we view multiples as compressing because of the various risks in the market? At the moment, we don't see that. We think the profits are going to be the reason why multiples come in incrementally, but ultimately the backdrop remains tremendously healthy right now.
Throw in credit to that conversation, Greg. What's the risk-reward profile like in, say, high yield in the United States after the little bit of spread widening we've seen over the last few months?
I'm actually more excited about credit in 2022 than I was this year. So we're quite bullish on high yield. I still think that is the case. But the investment grade corporate market is the real interesting part of the market, I think. So spreads are actually wider year to date in spite of the really strong growth backdrop and in spite of deleveraging. So I actually think risk reward investment grade corporates is looking increasingly interesting. And I think capital will start to shift as we get to 2022, as I think credit is looking relatively more attractive versus equities, whereas you could not say that was the case over the past 18 months.
How many moves have you made recently, Greg? Have you sat on your hands? Have you just sat this one out? Or have you made some moves in the last week?
Well, so I think it always pays to be a long-term investor. So I think the short term is really, really difficult here. And so we were just kind of debating going into this interview amongst ourselves, are you going to have a year-end rally or a year-end sell-off? I think it's really a coin flip. I think it's that difficult to ascertain. So I think you need to take a longer-term perspective. You have to tune out the white noise, and you have to focus on what your medium to longer-term value proposition is. And I think when you do that, you start to see more opportunities still in high yield, still in investment grade, and then local rates in EM is the area, I think, for 2022.
What I hear from both of you, though, and we can return to that call in just a moment, is that there is this belief, this conviction from both of you that we go back to this low-growth world, down towards trend growth of, say, 2% in America, and maybe threatening to break below that. Patrick, what would make you sit there and say, you know what, maybe we don't? Maybe this could continue, not at this rate, because nominal growth is explosive right now, but maybe something above 2, 3, 4%. Why do you truly believe we haven't broken out of that low-growth world?
Well, I think ultimately what it comes down to is the demographic factors which drive real GDP. At the end of the day, your GDP is really a function of how many people you can put to work and then how productive those individuals are. We can't make more people, and we definitely can't make them in short order. So we are stuck with the population growth that we have, and that is going to be around 1.5% over the next couple decades. So the question becomes, can productivity be that bountiful increase that drives us meaningfully above it? In a lot of ways, I think the answer is not really. And oftentimes people think of productivity as a benefit from technological innovation, but that does a disservice to technological innovation that's been happening over the past hundreds of years. So the invention of the light bulb, which elongates the workday, people cast that aside and they say, well, we now know where a train is on the train track because of the Internet of Things. Does that make it more productive? It's certainly helpful, but does it meaningfully alter the productivity of an individual employee? I think the conversation, is difficult to have. And we don't think productivity is going to be that driver to really offset the demographic factors.
Hey, Greg, I hear a similar thing from you as well. You just don't believe we've broken out of the low-growth world that existed and persisted before the pandemic.
No, I agree. I agree with the demographic argument, absolutely. Also, let's not forget the amount of debt that we added to the system in order to fight the virus and to help out here. So that acts as an impingement on future growth, impingement on future inflation. So the hurdle is that much higher going forward. So I do think there have been some productivity gains, coming out of this crisis, but I don't think it's enough to offset the tremendous amount of debt coupled with the demographic picture that's going to slow growth down.
Greg Peters sticking with us alongside Patrick Palfrey. Jill Carey-Hall of Bank of America joining us very shortly. Just got to work out some technical issues with her. Coming up on the program, counting down to a big week for central banks.
The Federal Reserve doesn't want to effectively punt the December meeting further out. They want to get on with this speeding up of the tapering.
24 hours and 3 big central bank decisions coming right up. From New York, this is Bloomberg.
Competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever, but nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has 3 very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the US to the UK, and now it's open, of course, to UK nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
When you start late, at some point, developments on the ground force you to go faster than you would normally want to go. And if you go faster than you normally want to go, you risk breaking something. And that's the problem of a highly leveraged economy, is that if you are late, you risk making a policy mistake.
We're counting down to 3 big central bank decisions. SocGen expecting the Bank of England to wait until February to make a rate move, saying the following: delaying to a time when there will be less uncertainty about both COVID and the economy makes sense. By contrast, the FOMC on the 15th should still see a decision in favour of faster tapering. That's an easy sell by a hawk to a dove because it commits the Fed to nothing on rates. That makes sense. Then one ECB official confused everyone, suggesting a move on rates before winding down QE. The governor, Holtzman, saying the following: I've always been against linking the bond purchase programme and rate hikes too closely. Interest rates could be increased while net purchases are still in progress. Mike McKee joins us now for more. Morning, Mike.
Good morning, John. Well, we know Mr. Holtzman is a rather hawkish fellow, and it doesn't make a lot of sense to raise rates while you're still trying to stimulate the economy because you're working against yourself. But that doesn't mean there's going to be a lot of focus on the ECB this week and the Fed and the Bank of England as the world's major central banks come to a fork in the road. The major QE assistance they have provided to the global economy and their own economies starting to fade out. Here's the Fed, and here's what we're going to be watching, John. Everybody knows the Fed is likely to taper. It's what happens next, and this gets to the BOE and Holtzman questions. When do they start to raise rates? You can see there was one rate hike, half a rate hike sort of priced in for 2022 in September when they last did the dot plot. Now, how far does that move up? You can see the green line. That's what the market thinks is going to happen. We're going to have at least 1-2 rate hikes next year. And then at the top there, when do they come to the final resting place? Where do they stop? 2.5% has been their forecast forever. But if inflation is really a problem, do they need to move that up? So that's the debate for the Fed. In the markets, we've already moved beyond the taper aspect. For the Bank of England, it is, as you mentioned, a question of when do we raise rates? They're set to phase out their bond buying program. You can see that although the line's gone down, that's still a very aggressive pace of rate increases, looking for more than 3, almost 4 rate hikes in 2022. They'd probably get started in February if they need to do that many. The question, of course, for them and everybody else, Omicron, but by that time, maybe it will be better. And then we go to the European Central Bank, which is going to be the outlier here. They are expected to announce an end to the pandemic emergency purchase program, ending it in March. They'll keep going until then. But there is a lot of pushback against Mr. Holtzman from members of the governing council, including President Christine Lagarde, who say there's no reason to raise rates now. You can see why they would get rid of PEP, though. It was designed, those are the PEP purchases in blue. It was designed to pull the economy up and raise inflation, and it did that for quite a while, but now we've got inflation without a whole lot of benefit from the PEP program. So you can expect a lot of changes next week. It is time for people, I guess, to start changing their investment portfolios. You know what Yogi Berra, the American baseball player, said, John, when you come to a fork in the road, take it.
Thanks, Mike. It's helpful, isn't it? Mike McKee, Thank you, sir. Mike McKee on a week ahead, and what a week ahead it is. The Federal Reserve kicking things off, followed by the ECB and the Bank of England. The big conversation is very much about liftoff. When do we get that liftoff? What's the sequencing of the whole thing? And then what are the limits of that effort to raise interest rates? Joining us now is Jill Carey-Hall, Greg Peters, and Patrick Palfrey still with us. Greg, I want to come to you on sequencing, and then I'll come to you on the equity market. Jill, thank you for being so patient with us. Greg, the sequencing here, is that confusing to you from the ECB? Just one official I know, slightly hawkish, maybe very, very contrarian, should consider him an outlier. Would it be complex to say we'll continue doing QE, but you know what, let's hike interest rates?
Yeah, I mean, it doesn't make much sense, clearly, but it speaks to just how the communication is so varied and so confusing across the board. And so you're having a lot of rhetoric coming out of all central banks, and it's giving mixed messages. And more importantly, what you're seeing is just dramatic shifts. What the markets like is consistency, right? Not dogmatic, but consistent. And what we're seeing happen by central banks today is radical shifts, right? You've seen it with the BOE earlier this year. You saw it with Powell last week. And so I just feel like this added rhetoric coming out of global central banks is just a vol event, honestly.
It's very difficult to understand. You consider it a vol event, other people consider it to be much more material, something that's going to be living with us through next year. Morgan Stanley's Ellen Zentner saying this, we now expect, in fact, this is from Bank of America, we now expect the Fed to end its QE program in March. We still expect liftoff in June, but March is in play. Jill Carey-Hall, I wanted to come to you on that Bank of America quote, because I know that you are less constructive on the equity market. You think Tina is facing a massive threat right now because you believe this central bank has to hike.
Yeah, we're only forecasting a flattish market through next year. We have a 4,600 year-end target on the S&P 500, and you have the Fed tightening into a overvalued market. You have very bullish equity sentiment. You have earnings growth slowing to trend. We actually think dividend growth will be better than earnings growth next year. But with the rise in rates, we would expect that the argument, Tina, as you mentioned, there is no alternative argument for equities gets more called into question if cash yields are rising, so that dividend yield on the S&P 500 isn't as attractive as it once was. So for us, we see more opportunities within pockets of the market rather than just buying the S&P 500 for next year.
Jill, we've had a conversation earlier in the program, and I appreciate we had some technical problems, and our apologies for that. Patrick Palfrey, much more constructive. Greg Peters as well, suggesting that there are limits to how high the Federal Reserve can go. Can you give me some insight into how high you think they go with the team at economics over at Bank of America, and what you think the break point will be for the index level story?
Well, we expect, and as you mentioned earlier, that the liftoff is expected to be in June based on our economists' forecast, but could be as early as March. Obviously, the taper timeline has been accelerated, and we're expecting that they hike rates 3 times next year and then continue the pace of tightening into the year after. So, equity markets tend to actually be up during the heightening cycle, but as we mentioned earlier, we are seeing very elevated valuations, Fed tightening into an overvalued market, which can be more detrimental. For small caps, which is an area that I cover, we also, do tend to see rather, lackluster returns once the Fed starts tightening. So that is one potential risk. But I think one of the big differences today is that, small caps are actually trading at a pretty hefty discount to larger stocks. So it's actually the only tightening cycle that we're heading into besides 1999 where smaller stocks weren't expensive versus larger stocks. So, potentially one difference in going into this tightening cycle.
We're going to build on this still ahead. Jill, Patrick, Greg, coming up, the morning calls, and later, Apple and Intel leading the charge in the pre-market, helping extend the rally for big tech into a second consecutive session. From New York City, this is Bloomberg.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Five minutes away from the opening bell in New York City this morning. Here's the bounce at 1.2% on the S&P 500. On the NASDAQ, a nice rally, a tiny one at 1.7% on the NASDAQ 100. That's the equity price action. Here are your morning calls. We begin first up with Guggenheim, downgrading Merck to neutral. The analysts expecting competitive headwinds and weakening sales of its COVID-19 medication. We're down there 1.93% to 72. Next up, MKM, upgrading Starbucks to a buy. The analysts taking a more constructive view of the company's longer-term prospects. We're positive there by almost 1.9% at 115.12. And finally, Morgan Stanley raising its Apple price target to a street-high 200, matching Dan Ives over at Wedbush. The analyst Katie Huberty seeing benefits from new product categories. That stock at 169, up by 2.28%. Coming up, big tech pointing to another big day of gains. That's next. This is Bloomberg.
Urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
A big pop yesterday in the equity market from New York City this morning. Good morning. A big pop this morning on the S&P 500 up 58, advancing 1.27%. On the Nasdaq 100 right now up 276, advancing 1.74%. From New York City, the opening bell ring is switch up the board and get to the bond market. 10-year yields look like this. They're higher by a couple of basis points to 146 at the front end at the highs for the year. This debate around rate hikes continues, and the FX market a gap lower about an hour ago on euro dollar to 112.37, negative 0.4%. We did have a 111 handle a few weeks back, November 24th. They were the lows of the recent lows anyway over the last couple of months, negative 0.4% there on euro dollar. Crude up 2.5%, 71.24. Around the opening bell, then about 25 seconds in, we advanced 1.2%, leading the way information technology, top in a pile. We are up by more than 2% for that industry group. Utilities lagging, as you might expect, on a day like this morning. We're basically unchanged on utilities. We'll turn back to IT in just a moment. Victoria Green of G Squared weighed in on where she thinks the risk reward is right now. Take a listen.
We think value is a really great place to be a little more cyclical, overweight the Russell 1000 value. Energies, the financials, the industrials, I think those are some better plays right now. Tech has been difficult, and some of that might be with the potential of the 10-year and rates coming up and not hurting the discount rate. But we think the market is certainly where I want to be. We are overweight equities going into next year. I think the fixed income market bears just as much risk as the equity market with a much lower potential return. So absolutely, we're keeping our overweight in stocks.
Victoria Green, overweight stocks. Back with us, Jill Carey-Hall, Patrick Palfrey, Greg Peters. Patrick, I want to come to you. We missed you last time around. My apologies for that. Start with your index level call for next year and why you still believe the risk reward makes sense for the index level going into nenext year. Patrick.
So right now, our expectations for next year is to finish around 5,000. And really what that comes down to, and Jill hit on it earlier, when the Fed hikes, it's typically a good backdrop for equities because we need to remember why the Fed hikes. What they are doing typically is we are entering the normal middle innings of an economic cycle. That is a good period for equities. I think right now there is a concern around inflation, but inflation is a positive for profits, particularly when you don't have the offset from higher interest rates, and we're not seeing that right now. So I think there's a lot of reasons to be positive. I think the concerns could potentially be if China growth slows, or perhaps right now we don't see it, but if the Omicron variant shows worsening data in terms of deaths or hospitalizations. But right now, both of those seem to be also helping out the market. So we see a very constructive backdrop at the moment.
And Jill, to be clear here, Bank of America is very constructive on the economy, just not constructive on the index. You de-emphasize the index level call and focus on what's happening beneath. Can you just return to that for us, Jill? Why is that?
Sure. Well, I think, there's a number of headwinds that we see to the large cap S&P 500 index right now. I mean, the index has grown increasingly concentrated in a lot of, mega cap growth stocks, such that the index has actually become extremely interest rate sensitive, more so than historically. So, rising rates should be a bigger headwind for a lot of these growth stocks. As fiscal and monetary stimulus wane, if we see volatility, these factors are all positive for quality. So we like higher quality stocks. We would stick with value over growth, assuming that the COVID backdrop, we don't see a major resurgence there. We would stick with CapEx beneficiaries over consumption beneficiaries. And then we do like small caps over large caps, since, as you mentioned, we are positive on the U.S. economy. We expect that to remain an engine of growth next year. And smaller stocks are bigger beneficiaries of that and the continued recovery in services spending and the CapEx recovery, again, if COVID stays at bay.
And Greg, I wanted to bring you back in and finish on this. You mentioned that tilt towards EM. Just briefly, I wanted to return to it. Why is that, Greg?
Well, so EM has really lagged here over the past 18 months. It's been atypical, right? The global growth story is typically quite good for EM, kind of a high beta play. It's been largely a value trap across fixed income and equities for good reason over the past 18 months, just the struggle with vaccinations and the virus broadly. But there's a lot of bad news in the price currently. There's lots of rate hikes priced in. And then we think global inflation is, subsiding. So you put that all together, and it seems like a pretty decent environment for EM in 2022. maybe not the first quarter, but as you work through the year, start to see value there for sure.
Greg Smart, as always. Greg Peters, alongside Patrick Palfrey and Jill Carey-Hall. To all of you, thank you. In the early part of this session, about 4 or 5 minutes, we advanced by 1.4% on the S&P. Utilities lag. Information technology leading the way up 2.2%. SocGen saying this, seeing the dip buying strategy continuing to be profitable. Let's get you to
retail investors looking to buy the dip, because this has been a strategy that's been highly profitable over the past few years. And the Omicron variant clearly creates uncertainty, but it doesn't really change the story. And as a result, we think that momentum will carry on.
That's the way TV goes sometimes, Taylor Riggs. I apologize. Taylor, good morning.
I'm just glad I'm ready for you, John. Let's take it away. Take a look, and you really mentioned some of that dip buying. Where we are, you've seen that at least when it comes to the Qs and some of the inflows that you see in the ETFs. Take a look at last week. You had one of the largest inflows that we've had now since June, right as the index was dipping, and that is continuing a little bit again this week. So you're really starting to see some of those inflows when it comes in here for some of the big tech names. As we talked yesterday, and John, I wanted to reiterate today, that's a very different story when we're looking at some of the Chinese technology names. How much of that is sort of that macro story on individual names of slowing growth? How much of that is some concerns about a big crackdown on big tech and some U.S. concerns about some of the transparency with the actual fundamentals? So with some of those like JD.com and Pinduoduo that were down the worst in some of the last week of some of those individual names. I will mention, though, leading here to the upside, at least on the day, let's get back to some of this micro news. Intel, of course, is a big mover on the day. They're looking at what could be a $50 billion IPO of the Mobileye unit. Morgan Stanley saying that this news is a significant positive. When you think about generating value from the business on a conglomerate discount versus a sum of the parts, could it be worth more and freeing up some capital? Apple's another one that we're really looking at here. John, you're up almost 2% now, more than 2%. Katie Huberty now raising the price target to 200, matching the street high from Wedbush. Really talking about virtual reality here and maybe that giving that stock a boost.
Taylor Riggs, thank you. And our apologies for that again.
All
Taylor,
good.
as always, professional and ready. Thank you very much. JMP Securities CEO Mark Lehman looking at more volatility to come, saying investors should, quote, buy the broken winners, the stocks that went up quickly and then fell when we believe things were going back to normal. You want to own sectors being disintermediated by technology. Mark Lehman joins us now, the CEO of JMP Securities, a Citizens company. Mark, just start there for us. Build on that, please.
Well, we had a theme of 2020 with technology and stay at home as being the dominant theme for investors for last year. That theme has kind of been roiled by the back to work trade for 2021. But I think a lot of what investors saw in 2020 is here to stay. That is, we're not going to go back to the office 24/7. We're using technology more for all of our daily lives and different facets of our daily life. And I think that is a roadmap for the future. A lot of those stocks have not had a great 2021. But if you pick through those names that have been afflicted there versus 2020, I think roadmap ahead is to own the tech winners for the long term. And there's a 50% off sale in some of those names you want to take advantage of.
Just some of those names, Mark, Zoom, Peloton. Are we ever going to evolve, get away from just considering them stay-at-home stocks? Do we ever get away from that, Mark?
I think we do. I mean, I think we've had that over time where we've had some names that we used to call them technology stocks, but technology really pervades our entire life. And you look at all the sectors that we're talking about, whether it's healthcare, whether it's consumer, whether it is tech, tech pervades every aspect of that. And I think we are going to get more and more accustomed to that. Certain parts of our banking, fintech, we're just going to be, that's just our future. Technology is going to pervade everything. Here at JMP, we think of tech as a horizontal, not a vertical. And that's what you're talking about, Jonathan. And that's what I think will happen over time. It'll just be part of every facet of our life. Healthcare. I mean, we can go on and on. Mobility and driving, et cetera. Technology is going to take over that part of our life. And I think that's the investing future that investors want to pay attention to as we get more and more into digitizing our economy and digitizing our life.
Mark, these are really compelling stories. Do the value of these stories matter, Mark?
They do. I mean, I think we had a big valuation discrepancy at the beginning of the year. We're saying, well, if we could pay 50 times revenue, why can't we pay 100 times revenue? And in the last 3 to 6 months, we've said if we're going to own these stocks, if we didn't want to own them at 100 times revenue, why do we want to own them at 50 times revenue? I think eventually these companies have to turn profitable, and these companies have to have a business case for what they do. I'll point to one that we were part of, an IPO for a company called Snowflake, which was the largest software IPO of all time. And that stock had a great run right out of the chute and then fell back a great amount. But they kept beating quarters. They beat one last week. And that stock is up over 50% off the bottom from the doldrums of the summer. And I think you're going to see more of that for stocks that we're describing. That is, valuation does matter, but it really is, do they have the marketplace and the market share that you want over time? And I think Zoom you mentioned, Peloton you mentioned, there's others that we have here at JMP that are going to own markets that are changing, that they're changing. We have a company called Doma, which is digitizing the title process for all of us who buy a home. When you buy your home today, it is basically replicating the closing process that your parents had and your grandparents had. That is going to change. We think Doma is going to be the winner in that digitizing process. That's what we're looking for at JMP.
DocuSign was another one of those companies, and then it had a 40% rout, 42.22% rout on Friday. Mark, I'm trying to understand, for a lot of people listening to this right now, if they want to allocate to this story, how do they do it? What do they avoid? What's the best way of getting investment exposure to this without getting the exposure to a single day move and getting wiped out for the likes of DocuSign?
Well, it really was jarring last week when they did report their earnings on Thursday. And like you said, the 40% rout. But look at the 2 and 3 and 5 year chart of DocuSign. And there were a lot of doubters 5 years ago who obviously benefited over time. And yes, we are going to have more competition in that space. But I think you got to look at valuation. You have to look at what their earnings are. They missed their guidance. That's never good for any story. It's certainly not good for a growth story. I think investors obviously have to pay attention what the growth expectations are. I think we saw the cracking of the stay-at-home all-time stocks like in October when Chegg, the textbook company, missed their earnings. And I think everybody had to recalibrate what they're paying for those stories, including DocuSign, and they missed their numbers. And you're going to get punished when you miss your numbers. And I think the stories that I'm talking about are their growth is accelerating. DocuSign's was not. And I think that's the real fundamental calibration investors have to make. And it's a very perilous journey when you invest in high growth, high multiple stocks and they miss their numbers. And DocuSign is an example of that. The few that I've given you, I think, are still ascending, and I think their valuations have come back to earth and a place that investors can pay attention to.
Mark, thank you, sir, for being with us. It's been too long. Mark Lehman there of JMP. Your equity market up 1.4% on the S&P, on the NASDAQ up 2%. Coming up on the program, US and European allies weighing Russian bank sanctions if Putin invades Ukraine.
The administration isn't certain that Putin is planning an invasion, but they do know that he's well poised to do so if he so chooses. There's currently an estimated 100,000 Russian troops along different parts of the Ukraine border.
More on those tensions next from New York. This is Bloomberg.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I noticed that.
Do you think I need a lift? Is it time
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
In reality, both Putin and Biden know that the U.S. is not committing to military direct support in Ukraine, even if there was an invasion. That has not been something that's directly on the table. So what Biden has to do is convince Putin that these economic sanctions would be impactful enough and would have such an impactful effect on the Russian economy and on the Russian people that it wouldn't be worth Putin's risk of invading Ukraine anytime soon.
The U.S. weighing Russian bank sanctions should Putin invade Ukraine. This coming as President Biden prepares to speak with the president later today. For more, let's bring in Josh Wingrove from outside the White House. Morning, Josh. What are you looking for later?
Well, I think the breadcrumbs, Jonathan, to look for in this will come in the readouts and the statements from White House Press Secretary Jen Psaki. Some of the analysts we've spoken to have said, look, if they're talking about a lot of things, that might mean that Putin might not get all that much of a direct message on Ukraine, but if the statements are all about Ukraine, in particular, if the Russians sort of frame it as Putin getting what he wanted, that could be a sign of de-escalation. As for the package that Biden is expected to sketch out, this is a joint EU-U.S. measures targeting banks, the Russian Direct Investment Fund, as well as currency conversion, Forex, to try to hamstring, if you will, Putin, give him a consequence of any measures he might take. They think, though, that he has not decided what to do. The big question we have, though, is what the U.S. will do if Putin takes half measures, if you will. They're framing this as sort of an all-or-nothing response. We don't know what will happen if it's more of a gradual or shades of gray incursion or some other type of interference in Ukraine by the Russians.
Josh, there's a difference between punishment and getting countries to change the way they behave. As a punishment, this can be severe. We've seen what's happened in North Korea. We see what happens in Iran, for instance. But when it comes to changing behavior, I don't see much evidence of that for North Korea, for Iran, for Russia, for that matter, either, Josh. What are they focused on, just the punishment, or actually trying to change the behavior of this country?
Well, I think they want a so-called stable and predictable relationship, but you're right. I mean, we're back where we were in some ways 7 years ago with the invasion of Crimea and the lack of settlement, if you will, in the Donbass. And at the time, the U.S. responded and NATO responded by cycling troops through eastern flank NATO allies. If there is any sort of incursion into Ukraine, you could probably expect to see that again. But they think it's easier to sort of back Putin off, if you will, by sort of threatening stuff before he does something rather than using these measures to get him to back down once he's actually done it. Now, the U.S. officials say they don't believe Putin has made a decision on what to do in Ukraine, and that, of course, leaves them sort of trying to affect his risk, cost-benefit analysis, and by trying to sort of lay out a credible threat. Now, whether Putin believes that this is a credible threat is a million-dollar question. And if he does move forward, then other things potentially go on the table, including the Nord Stream 2 pipeline. Yep. Of course, Germany supports that by my waiver, and the questions of SWIFT transfers, that's sort of a nuclear option. So far, the EU and U.S. aren't expected to be sort of mucking about with that.
Josh, thank you. As always, Josh Wingrove there from outside the White House. The tension between Russia and the United States right now. Here's some tension between the United States and China. The Biden administration boycotting the Beijing Winter Olympics. It's a diplomatic boycott. The White House Press Secretary Jen Psaki making the announcement.
The Biden administration will not send any diplomatic or official representation to the Beijing 2022 Winter Olympics and Paralympic Games, given the PRC's ongoing genocide and crimes against humanity in Xinjiang and other human rights abuses.
For the latest, let's bring in Bloomberg's Joe Matthew. Morning, Joe.
Good morning. What a contrast to hear these two stories back to back, Jonathan. What is it we're talking about here? You've got two countries who are in the midst of this whole debate here, and a major world leader essentially threatening countermeasures against the U.S. for not attending a party that the U.S. was not invited to? Isn't that what this actually is? Look, we're still sending our athletes there, and you've been referencing, Jonathan, throughout the morning, the statement from Press Secretary Jen Psaki that referred to genocide, but we are still allowing U.S. athletes to attend. We're not the only country that's not going, by the way. Just this morning, New Zealand announced it wouldn't go and said that COVID might have something to do with it. The fact that we're not attending, the fact that Joe Biden's not going to be in the stands does not seem to be quite the controversy that the Chinese are making this out to be, but some pretty offended folks on the other side of the ocean, Jonathan.
Joe, it's hard to square this, isn't it? It's really hard to reconcile. That language from Jen Psaki, and sometimes just reading it, I think, has a stronger effect.
That's right.
The PRC's ongoing genocide and crimes against humanity in Xinjiang. Do you think that a diplomatic boycott